Hello everyone, welcome to our 8th annual IFRS webinar and the first virtual IFRS session. It is unfortunate that the annual gathering where we can physically attend will be missed this year, but we at KPMG have adapted to the new normal and have transformed the dynamics of the day-to-day business activities. Before we begin, I would like to go through some house rules with you. Attendee questions. Your mic is on mute. You may submit questions in the Q&A button on the right tab. We will answer as many questions as we can during the Q&A. If we are unable to answer someone from KPMG, may reply via phone or email following the webcast. Your feedback. When the webcast is over, the webcast player will automatically refresh to display an exit survey. Feel free to complete the survey as your comments are very valuable to us. Recording. This session is being recorded and will be shared with the slides with you via email within 48 hours. Our esteemed panelists today are Gopal Balasubramaniam, our Head of Audit at KPMG Qatar, Yusuf Hasan, the Head of MESA Department of Professional Practice at KPMG, and Brian O'Donovan from the KPMG International Standards Group. Panelists, thank you for conducting this session today and offering your expertise. Now, without further ado, I would like to hand over to Gopal. Thank you.
Rian. Good morning, everyone. I'd like to welcome you all to this annual IFRS update course of KPMG Qatar. For the first time hosted in virtual mode due to the social distancing regulations arising out of the ongoing COVID-19 pandemic. For the benefit of those who don't know me, my name is Gopal Balasubramaniam. I'm the Head of Audit in KPMG Qatar. Been a partner at this firm for the last 13 years and been with this firm for the last 27 long years. Yes, I am an old wine, I must confess. Just one correction to the script. I didn't have the script of Rian, so I just want to correct her that we have been hosting this IFRS update course for the last 2 decades in Qatar for the financial professionals representing different industries, financial institutions, and the regulators. I could see already more than 180 of you are registered or joined already. More than 350 have registered for this course, which is by far a record for us. I'm sure others also will join soon to make it 350 for this show today. I know there are many participants who have logged in today, have already been attending this course year after year. I'm very happy to note that KPMG's IFRS update course is in the annual calendar for many professionals, financial professionals in the country. Initially, we started with Julie Wego. She was from the KPMG International Standards Group, and then Philip Longestay, he was from a firm called Gap Seminars, presented this course for us. And from 2007 onwards, one of the presenters whom we have with us, Yusuf Hasan, our regional guru in IFRS, has been visiting Qatar and running this course for us. His professional life for the last 2 decades revolves around IFRS. In delivering sessions like this and in answering IFRS queries from different clients of KPMG offices across the Middle East region. In KPMG, we always try and deliver the best for our clients. And Yusuf Hasan is one of our best on this subject available in the region. This year, we have also added additional layer to the quality of this course by roping in Brian O'Donovan, who is a partner in KPMG's International Standards Group. He's based in London, but is always keen to visit us and support us in our region for these IFRS seminars. Brian is a member of IFRS Interpretations Committee, the IFRIC. Within KPMG, Brian is the leader of our global topic team on revenue recognition and deputy leader of our global topic team on leases. I've attended Brian's IFRS sessions in the last few years. He's an amazing presenter and one who could make a dry subject like IFRS an interesting and entertaining one for us. Friends, after IFRS 9 on financial instruments and IFRS 15 on revenue recognition, these are the standards which came in 2018 for implementation. Then IFRS 16 on leasing and IFRIC 23 on uncertain tax treatments came in 2019. We didn't have new standards in 2020, but COVID-19 pandemic has thrown a lot of challenges for the accounting world in the application of a number of existing standards. So we'll start today with Yusuf Hasan, who will cover the accounting considerations from COVID-19 pandemic, the impacts on businesses from accounting consequences, whether assets and liabilities are carried at the right values, impairment issues in financial and non-financial assets, impact on financial instruments, accounting issues from government grants, which is very relevant in this part of the world. And then he'll also cover the practical issues from IFRS 15, the revenue standard, which was implemented in 2018. And then lastly, he will also touch base on interbank offer rate, IBOR transition. Brian will cover in this session some of the challenges in IFRS 16. He's a deputy leader for us in the topic team of IFRS 16 on leases. So he will cover rental concessions, which is relevant for most of the sectors in the countries in this region, especially because the rental concession is something which has been happening this year and after COVID-19 pandemic has set up. So he will also cover the latest on IFRS and IFRIC updates. As Rayan pointed out, there's a question answer time after every session, so you can flag in your queries and Q&A box, and Rayan will make sure that your questions are displayed on the screen for the benefit of all the audience, and the answers will be given by the presenters. With that note, I would like to hand over to Yusuf Hasan, who will start with the accounting considerations for COVID-19 pandemic. Over to you, Yusuf. Thank you very much, and look forward to an entertaining course. Thank you.
I hope I'm visible. Am I audible?
Yep, you are.
Thank you very much. I certainly do miss coming to the W Hotel out in Doha and having this course, but as we said, this is the new normal. Look, my first topic, as Gopal said, is, when I do my preparation for the annual update course, I did look at my agenda in good old January this year and said, what am I going to present? I mean, we've covered a lot of IFRS 15, we've covered a lot of IFRS 16. There would be some application issues. And obviously, when COVID came around, and there isn't a new accounting standard. However, what we do have is a lot of consequences and interventions from the ISB on that. So I'll be taking you through some of the accounting considerations of the COVID-19 pandemic. But before I start with the actual session, I just want to share with you some of the research that I've been doing. And when I say research, for a middle-aged guy like myself and Gopal, that means Facebook, right? So when I'm talking about the research we've been looking at, we try to look at in consultancy firms, what has been the most common sentence in 2020? And the answer surprised us. The word was, "You are on mute." Was the most common sentence that people ever uttered in that. Well, you as the audience will be on mute, but that doesn't mean that you don't have an opportunity to ask questions. Please do ask your questions. We'll try and respond to them during the session and over the break if we can. And then we said, look, I also did a little bit of extra research and read through a whole lot of consulting documents and tried to figure out what was the most common word used in 2020. And from a consultant's perspective, the most common word that came in all our consulting documents regarding COVID-19 was the word unprecedented. So in almost all marketing or any consulting document, you'll find the word unprecedented. But it is truly testimony to the times that this has been an unprecedented event. I know a lot of people, when the COVID-19 implications came around, people reminded me of 2008 in the region and the difficulties we had. Difficulties we had in UAE on government default of debt. We had the property bubble seemingly burst. We had share prices drop. But what I felt with 2008, the 2008 financial crisis, it was limited and restricted to certain sectors. However, the 2020 COVID-19 pandemic has had far-reaching consequences across all businesses. It's not been restricted to the real estate industry, financial services, or specific industries. All our clients in various different scenarios have been impacted in different ways by the COVID-19 pandemic. So as I'm saying, there isn't a new accounting standard that has been issued. However, what there is a whole lot of implications and considerations in respect of the pandemic. as I said as well, there has been some need for intervention by the ISB in some respects. For example, rent concessions. For example, there was some intervention in respect of IFRS 9, and there's been other thoughts going around in the IFRIC circles. However, there hasn't been anything significant in terms of a new accounting standard. There are implications to existing standards, and that's what I would like to talk to you about. I just need control of the slides. Can I just change the slide, please? I've got no control. Can we move to the next slide, please?
Hi, Yusuf. Just to let you know, you have control of the slide, so feel free to move to whichever slide you need.
Okay, there we go. All right, so look, what are we going to be talking about today? We're going to be talking about the key, in terms of the COVID-19 implications. We'll start by talking about the key impacts on business that have accounting consequences. As we said, these were industry agnostic. However, we have seen pervasive implications of the COVID-19 on that. And we're starting our focus on the balance sheet side. And I think the biggest concern on the balance sheet side from our clients were our assets being carried at the appropriate value. You know, the issues of impairment, fair value were all very, very relevant. Then the issue about liabilities. You know, the advent of COVID caused us to have some restructuring provisions. We've seen some onerous contracts, and we've seen various other redundancy type provisions kicking in for employees when people had lost their jobs. The question we're asking from the liability side is, are we recognizing those liabilities? Are we measuring them appropriately and presenting them correctly? With regard to financial instruments accounting has been something that we got quite accustomed to when we adopted IFRS 9. However, what we've noticed is a lot of the models and the formulas that we used for calculation of our expected credit loss were put to the test during COVID. Changes being made to lease contracts. We've seen a lot of rent concessions in our market. We've seen tenants go to landlords, landlords approach tenants in acts of sympathy and to provide concessions on lease contracts. Brian will be talking a little more on the lease concessions, but I'm just covering this in a very, very broad stroke here. Also, what has happened in the COVID world is government assistance. Government stepped in many of our instances to support the economy, to support certain businesses, to provide some degree of certainty. How do you account for this government assistance? For some clients, receiving this government assistance, government grants, subsidies were all new acts that they never had even an accounting before. And we're just going to talk to you about some of the considerations on government and assistance. Then in the broader financial statement impact, we'll talk about some other aspects. For example, post-balance sheet events, going concern applicability, we will briefly cover those topics. And then, just as a clean sweep, we'll just deal with some other accounting considerations that we think about. We will have a dedicated section, as I said, on IFRS 15, which will cover some of the IFRS 15 considerations, and we will have a dedicated section on IFRS 16 as well. But before getting to the accounting, to get to the accounting, we needed to look at the implications on the business. And different industries were impacted in different ways due to COVID. And these were direct consequences of COVID. Some industries, some might argue, were already on a decline in different ways, and COVID might have been the catalyst for that. Now, what we've done is gone through various industries, various reports, and done through various consequences in the region and try to highlight some of the implications we've been seeing in COVID and the impact on KPIs. In terms of impact, look, in some businesses, yes, there was a massive increase in online businesses and online sales. However, what we did observe is there were a lot of companies, retail companies, going out of business. From where I was looking, from my local mall down the road, there were a number of stores that had closed down forever. Gone, closed, with the sign. They were a thriving business in January, closed by April, and no sign of opening even in the short term. So with restaurants, with various businesses, we've seen this. So look, some businesses had increased in revenues. A lot of the online sales, there'd been a massive increase in online transactions. Certain things in certain markets, like computer equipment, laptops, iPads, they've seen increasing demand and increasing revenue. However, certain areas of the economy were extremely heavily hit. The local gyms in my area all closed. I mean, I'm in a vicinity of about 20 or 30 gyms which have certain personal trainers, and a majority of those closed during the COVID time. Some of them adapted due to different models where they tried to take things online, but generally business changed. Now, what we saw, or what we're seeing is, look, lower revenues is something that is expected. There were higher costs of redundancy, restructurings. All these elements materialized in 2020. We've also seen lower gross profit. We've seen unavoidable fixed direct costs causing problems. So, we've seen companies having to absorb a high turnover. And in the Middle East, as you're aware, rentals in malls tend to be very, very high. And if the footfall isn't there or malls are closed, this has a massive implication. We're expecting EBITDA to be reduced and also CapEx. Let me come to the issue of CapEx. We've seen many CapEx or capital expenditure projects delayed or put on hold in 2020. And these have caused implications. We've also had to look at the work in progress to see whether it has been impaired. Our clients also tell us that various investments that they had tend to be impaired. The return on investment is reduced. And most importantly, I think there was a problem with free cash flow. And this was something that our banks and our restructuring departments spoke about. If I go into just some of the other KPIs, and this is broadly what some of the impacts we're seeing. Look, these are self-evident, and there may be different impacts in your market across different industries. But what we're saying is that the impact on KPIs or numbers on business has been pervasive, and it has been significant. So therefore, the accounting for this would consequently be impacted. In terms of certain industries, let me highlight some of them. I mean, airline industries, and we've been talking to our airline clients, massive challenges, cancellations of flights, onerous contracts, trying to fulfill things. And look, a lot of the airlines in our region had to change their orders of aircraft in the last year. I've seen a number of cancellations, a number of different fleet situations occurring. So I thought when they applied IFRS 16, this would be a significant change, and it was. When I looked at the local airlines and of those with the financial statements were publicly available, IFRS 16 had such a significant impact on their balance sheets. However, 2020 posed a different kind of challenge. And looking at the interim results, we saw significant drops in numbers, obviously because of the restrictions on flight cancellations and onerous contracts that arose out of that. What we also saw in the tourism industry as a consequence of the reduced travel, and places like Dubai, Abu Dhabi, and I'm sure to some degree Qatar would suffer from a lot of people not coming into the country. I think we look at almost 80 to 90 million people coming through the airport every year to stimulate the tourism industry. And all the industries that linked to it were also impacted and had various issues, including impairment of assets, restructuring provisions, liabilities. Our oil and gas companies, our energy and resource companies, I think at one point in the lockdown, oil was almost negative, or was negative. There was a cost of actually picking up the oil. And this has had a pervasive impact. In fact, I recall having to do a very, very complex scenario analysis and sensitivity analysis for an oil and gas company during that period of negative oil price. Insurance industry. Now, this is quite interesting. I mean, why are we on the cusp of adoption of IFRS 17 for many of these entities? We were asking the question about who's underwriting the COVID-19 risk. Well, who's going to bear the risk for the cost, the increased medical costs, the increased mortality that comes around with this? Who underwrites it? Who reinsures this? How are the risks catered for? And how are the increased medical costs working on the unearned premiums? So this is a question, and we're trying to factor that into our IFRS 17 situation. In terms of giving you a UAE perspective, there was a temporary stop in circulation of newspapers, magazines, etc. in the UAE. I'm sure this is something you've also experienced. And this year meant that newspapers, the advertising industry, were all impacted. Mobility, the automotive sector, also heavily impacted. Real estate was quite interesting. I think what we're seeing in the market at the moment is very, very unusual. We're seeing properties bottom out. We're seeing some of the construction is continuing, and the off-plan sales started continuing. So like 2008, we saw very different sides of the market. We either see speculators coming into the real estate market trying to get a bargain, or we're seeing different kinds of scenarios with regard to people being conservative. In certain areas of property, retail, commercial property, we're seeing very, very big changes and impairments for people or owners of commercial property. Consumer and retail sector, it's been a very, very mixed bag. Certain entities that were focused on the online kind of trade seem to be flourishing, whereas others were changing their business and had to change their business models going forward. Now, that's just broad context, and let me get into the accounting areas now and all that. And I think, look, the one pervasive message you will be getting from your auditors this year is the issue about impairment. A lot of times we do think about impairment, but sometimes we think about impairment when there aren't any indicators or triggers of impairment. And that's just good old conservative accounting, but we don't normally do an impairment test. However, the events of 2020 have put us in a position where you can't argue away the need for an impairment test, because there may be consequential issues that arise through various aspects. I mean, people are looking at their head office buildings. People are looking at various other capacity issues. If I had to look at my local cinema, the capacity of a cinema at the moment, although they've reopened in Dubai, there's a maximum of 5 to 10 people in the cinema on a premiere of a movie, whereas the original capacity pre-COVID might have been 80 to 100 people, and these cinemas were full, and we needed to make reservations in advance. Now there's various reasons due to spaces, etc. Future income, although the existing capacity exists, the future cash flows that are generated from there tend to have diminished. So what we're going to talk about in this section, I'm going to be talking about non-financial assets. When I say non-financial assets, we're talking about property, plant, and equipment, investment property measured at cost, and we're talking about intangible assets, right of use assets, anything on the balance sheet that's non-financial. Financial assets will have a separate section to cover. These will be the IFRS 9, the investments, which are at amortized cost, and you've got to worry about the ECL calculations, and you've got to end other portfolios of investments that you may have, whether they're equity investments or debt investments. Those are a separate section. We'll deal with them. But this area of focus is on your buildings, your PPE, your investment property, those kind of assets, and I would say almost inevitable need to do an impairment test. I won't say impairment is inevitable, but I would think that there would be at least a need or your auditors might request you to do some kind of impairment test this year because there's clearly an indicator of impairment. We'll talk a little bit about revenue cycle assets. I'll cover it again in more detail in the IFRS 15 section. But when I say revenue cycle assets, we're talking about inventories and contract work in progress, essentially, and how these assets may be impacted. They are not the same as PPE. What about debtors? What about people who owe me money, who are asking for concessions? What about people who have missed a payment or two? And how do I account for that? What about stock? Because of the lockdown, I can't sell my stock. Imagine the little good old duty-free store that at the airports, and the airports were closed for a number of months, yet they had lots and lots of stock of food and edible items that needed to get. Finally, in terms of the asset situation, fair value determination. Now, I recall in 2008, when we had the global crisis in 2008, a lot of people questioned fair value. Is the market right? Is this just a blip in fair value? Can I adjust the market value? Things will get better. And, that was always the sentiment. I mean, people were saying, look, we've always seen countries in the Middle East rebound from low fair values. Should I book a loss because there seems to be a temporary decrease in fair value? Some of our clients saying, look, the market is wrong. And this is a very, very common statement we've had from clients. I think the market is wrong. These are conditions of reduced liquidity or crazy situations. We would like to move away from market valuations. Can we do something else? If the market is unreliable or if the market is inactive, can we move away from the fair value? And I think that's the questions we'll try and answer. But let me go through each of those topics now in a little bit more detail. Let me explain to you how I've laid out these slides. The way I've laid out these slides, what I want to do is I think I've got 3 columns. The 3 columns, one is the issue that you need to identify, the trigger issue, the trigger event. The second column would be what you need to do. And the third column is what you need to tell your users. What is your disclosure? You've got to understand that your users of financial statements, your shareholders, your lenders, government agencies would be now more than ever interested in these impacts. Look, clients come to me and say, should we be providing information in the context of unreliable estimates? I'm saying to them, at least in this context, disclose those uncertainties. Take your user on their journey so that they can understand your estimation process. You can't step away and say, hey, I don't want to measure things in 2020 because of uncertainty. So I think the 3 points we're going to go through in the section on all the topics are the key points, what you need to do, and what you need to tell your users as far as disclosure is involved. But let's talk about the impairment. And we're talking of non-financial assets, including rights of use assets, as we said, PPE, commercial property, rental property, etc. Now, just another point of anecdote here is a lot of companies are thinking or revising their view about work from home. And they may have additional extra capacity in their head office buildings. Or, they might be landlords and clients are not extending their various leases, or there may be cancellations or various aspects of that. The point I'd like to make, and I'd like to draw your attention to key point number 1, trigger events have definitely happened, which resulted in significant deterioration in economic conditions and increases in economic uncertainty. People really don't know what is going to happen. And in fact, till today, a lot of businesses, there still remains a large degree of uncertainty. So what we can conclude is the trigger event for impairment has occurred. What is extremely difficult is now to predict the future. As we said, it's an uncertain future. We don't know how business will materialize in the future. Who will recover? Who will come out of this storm? Whose business model will be resilient? Those traditional impairment calculations that we used to run through with the traditional growth rates and the limitations in growth rates could be under challenge. The third part, or the third point we're making is, look, in terms of the impairment calculation, it's cash flows and against the discount rate. But, during the lockdown period and subsequently, people were questioning what is the correct discount rate and how do we adjust the new risk-free rate in the context. And the fourth point, I think, as a trigger event and something we need to be looking at is the impact of useful life and residual value of assets. We have to depreciate assets. We depreciate assets to a residual value over its useful life. The standards say we should be reviewing this at least annually. IAS 16 says we should be reviewing, and 38 says we should be reviewing the useful life of our assets at the useful life and residual value at least annually. I'm sure many companies don't do that as a matter of discipline, but I think the events of 2020 may force you to relook at those more carefully. Now, what do you have to do about that? I think from a management perspective, what you have to do is consider, look, are there impairment indicators? It's a difficult argument to say they aren't. Probably do a lot of impairment indicators, impairment testing around your assets. Some clients who had relatively stable businesses may not have given proper consideration to what constitutes a cash generating unit versus a standalone asset. And we've had to help some clients determining what their cash generating unit actually is. Then in terms of the cash flows, we look at your budget. Is your budgetary information, your MIS information correct, appropriate? Can it be relied on? But, usually we used to base our future projections on the past. But in a context of uncertainty, are those budgets, are those projections still valid? Then we look at discount rates, and also management was also look at the useful life and residual value. Now, what do you need to disclose in this context? Well, look, tell the user, everyone is expecting there to be uncertainty. Provide your assumptions to determine the recoverable amount. Provide the sensitivity. Look, people are aware that there is uncertainty. Management will have to take a position to provide a number. Provide those assumptions. Disclose it. Be transparent about those assumptions that you've made. And provide those assumptions. Document it. Show the major sources of estimation uncertainty on various items. If we move on to revenue cycle assets, look, what could be impaired to is receivables and contract assets. Now, that assessment would be under IFRS 9, where we would make an assessment on those matters and decide whether they are impaired or not. Generally, we carry inventories at lower of cost than net realizable value. Is this an instance where we'd have to do the write-down of our inventories? We always state this in our financial statements, and a lot of times, I've seen very seldomly industries actually do the write-down because there's always an increase. You are going to make some profit over the cost. However, due to the, especially when I've seen in some of the edibles industries, the trading and commodity industries, some of the inventories are having serious impairment issues. The impairment context for inventories is under IS2, which is a different regime to what it is for receivables and contract assets. Contract costs, capitalization of contract costs, and maybe to some degree borrowing costs. I'll talk about borrowing costs towards the end. But, we do have under IFRS 15 certain rules about capitalization of contract costs. And some of the requirements we need to reassess are those costs still expected to be recovered? Is the amortization period intact? And is that contract cost impaired or not? So what management have to do? Let's talk about those aspects here. You have to look at those contract assets and receivables for impairments as per IFRS 9. Look at your estimations for inventory. Review the amortization period of contract costs and consider the capitalization going forward. In terms of disclosure, again, because of the degree of uncertainty, your numbers are less reliable or less, I think, are calculated in the context of greater uncertainty. Therefore, you would need more clear and meaningful disclosure. Fair value. Now, where would I use fair value? Look, I may have some investment property that's measured at fair value. Maybe I'm carrying intangible assets that are sold in an active market. that I'm carrying at fair value, or various items may be carried at fair value in my financial statements. Now, the question that we have is, how do I determine fair value during this time? There are lots of unobservable inputs. There are certain industries where there aren't any activities. So we need to look at the conditions at the measurement date. We can't say the market is wrong if there are active transactions. I mean, I've had a number of conversations with clients who are trying to say, can we depart on assets where there is a quoted market price, or property where they have a quoted market price? They're saying, can we move away from the current market valuation and take some kind of other optimistic view? And that's a very, very interesting view. And this, you can't normally just depart from an active market price if there is pricing information provided by the activities in the market. You can't wait for a happy day or a better day or look at something that's optimistic. You can't ignore the fact that there is a liquidity situation, and the liquidity situation, or a situation of uncertainty, and create a discount or an addition to fair value to undo this uncertainty. You see, the definition of fair value requires you to look at the market participant view of something. But take into consideration, there are elements of the fair value calculation may be different going forward. In terms of what management should do, management has to look at the impacts, look at the market values, look at risk premiums arising from increased uncertainty. What we expect is, there will be a departure from level 1 and level 2, and we expect there to be significantly more level 3 valuations. What is a level 1? Level 1, straight from the market, taking the information, a quoted market price, unadjusted. A level 2 price would be using market observable inputs. And a level 3, again, goes a little bit further away from a direct quoted price, but using more management judgments or less market observable information. So what we expect here is for there to be more level 3 valuation, but it doesn't mean departing from a valuation. Sometimes people ask me, can I revert to cost? Cost, no. Cost is not a fair value. Cost is how much you paid for this historically. Fair value would be how much a market participant would pay in a hypothetical transaction. And now I think the arguments people tend to make is, hey, there's no market. Can we not get a fair value? But I think those are not areas we can. In terms of disclosures, what do you tell people about these fair values in these uncertain situations? We're expecting a lot more level 3. Provides information about that sensitivity. Provide that information, provide that context with the key assumptions that are made by management. After moving away from the asset section, let's talk about the liabilities. And I think the question around liabilities, there's few kinds of liabilities, but I think the biggest concern for me is, are we capturing all the liabilities? Have we got all these liabilities? New liabilities may arise, different liabilities may arise as a consequence of this. Are we calculating? Are we correctly recording them? Let's talk about three types of liabilities, and I'll tell you from practice some of the questions we have been getting from clients. Unavoidable liabilities and loss-making contracts. So you might have had onerous contracts and loss-making contracts. And these contracts were never intended to be loss-making, and they, as a consequence of COVID, there have been changes to the market, there have been changes to situations, and these contracts are now, you're bound by them, they are enforceable, you cannot get out of these contracts, and you're obliged to continue with them, and they're unfavorable to you. What should you do about it? Restructuring provisions, and this has been a very, very interesting area of discussion I've had with a number of clients. I've seen a lot of press releases with rumors, sometimes facts, about companies willing to undertake restructuring. The question for me on the restructuring provisions was when do you recognize it? I think if sometimes companies are announcing we are going to restructure, we intend to get rid of 10,000 employees. can they raise a provision in that quarter when they make that announcement or when that comes to the market? And this was some of the questions that the entities were asking. A lot of companies use the COVID-19 situation as an opportunity to get rid of old staff. There was a lot of restructuring. We've seen significant job losses in the airline industry, in the tourism industry. And those restructuring provisions, I think the big question on those was when should we recognize it and how much? And look, in some cases, to be honest, you didn't qualify for recognition at that quarter end, although you might have had some kind of idea or plan, but you didn't fulfill the chain or that would require it to be made an obligation. In terms of employee benefits, we've also seen some very interesting situations. I mean, there has been a lot of companies requesting their employees to make salary sacrifices. We've also seen a lot of terminations. Now, I think in terms of terminations, very interestingly, a lot of the elements of IAS 19 we had to dabble with again. IAS 19 dealing with leave pay, we've looked at post-employment benefits. I'll talk about those two separately. But in terms of leave pay, companies were forfeiting or asking their employees to forfeit leave or take their leave, or various elements of that happened during the lockdown. And those created a lot of changes in the traditional leave pay accrual kind of accounting. But I think of pertinence to the Middle East, and I think this is an area we need to look at, is companies have changed their profile of employees, and the end of service benefit that we currently have in this part of the world, where you pay your employee based on number of years of his last salary multiplied by the number of years of service, is a post-employment benefit which should have been actuarially determined. But these assumptions and variables post-COVID has been changed significantly. Let's talk about these unavoidable liability and loss-making contracts. So look, we've seen some sales contracts being made which are becoming onerous. When we say it's an onerous contract, the cost of fulfilling the contract exceeds the benefits from it. And when this is the case, and this is one of the rare cases in IFRS where you make a provision for future loss, you would provide for that. The cost of the provision or the measurement of a provision for an onerous contract is the lower of the cost of exiting, very simplistically, exiting the contract or continuing, whichever is lower. So you're still a bit, you're not very conservative. You're not taking the higher of the two, you're taking the lower of the two. But people have to look at these contracts again. If they are in contracts, supply contracts where they've promised the customer something, or the customer has engaged in one side to pay a certain amount, whereas your cost of providing that service or that good has now increased significantly, and it's going to be a loss-making contract, this may give rise to an onerous contract. Also, what has happened is we've looked through contracts and applicable laws, and this concept of force majeure came into discussion quite a bit. Is COVID-19 a force majeure event, were some of the questions that were asked, because when these force majeure events do occur, they create alternative or parallel consequences to the original contracts. And we needed to understand whether these were covered. This is a significant legal discussion we've had in our part of the world. Different contracts had different outcomes, but in most cases, I can say from experience, the COVID-19 was not identified as a force majeure issue. Another thing is, look, I've had a lot of clients coming to me and saying, look, we are picking up impairments on assets. We are picking up a lot of losses in the year. Can't we just write 2020 off? We'd like to create a lot of conservatism. Let us provide for future losses so that from next year onwards, things will be a lot more stable. However, IAS 37 doesn't allow you to provide for future economic loss, for future operating losses, for future businesses. IAS 37 on provisions requires there to be a contractual or legal obligation. And based on the definition of a liability, there has to be a present obligation. The only time you sort of have a executive contract becoming onerous is if it meets the onerous contract. recognition. So generally, we couldn't allow our clients to provide for future losses. You cannot say, hey, I'd like to take all the pain in 2020 and let's have a good year next year. And I think that was some of the thoughts and the thinking of some of the clients that, look, we realized we cannot avoid an impairment, but can we take the losses this year? This is not something that IFRS allows operators. I think what you need to do in terms of unavoidable liabilities, look at whether any liabilities are triggered. I think this requires a review of contracts. Look at some of the arrangements, some of the service contracts, some of the long-term contracts you've entered into where costs or there have been delays. Relook at the projections of costs. Relook at the benefits that you are getting. In terms of contracts with customers, with suppliers, review termination clauses in key purchase and sales contracts in order to determine exit strategies. Speak to your legal department, see if COVID-19 falls under the force majeure clause in your jurisdiction. And look, I think what we needed to do, and one of the guidance points here, if you have an asset and that asset is potentially impaired, look at the impairment test before recognizing a provision for an owner risk. And again, once more, because of these consequences, we need to provide clear, meaningful disclosures to your users about these assets. Restructuring provisions, and I said this has been quite under debate at the moment, or quite prevalent, not under debate, I think prevalent at the moment, where a lot of clients are saying to me, look, we've made an announcement in the paper, we intend to reduce our workforce by X%. Should I be recognizing a provision? Have I triggered off the provision? Back to IAS 19, it says, look, a restructuring provision is only recognized when both conditions are met. And the first one, there is normally a detailed formal plan for the restructuring. But the second one is where we always found, in the cases where we didn't qualify, is where the company has raised a valid expectation in those affected that the plan will be implemented. So if it was a broad-scale plan without much detail, which wasn't actually binding, was on anyone, we didn't allow the client to create the provision in that period. Also, what we needed to look at is, in some cases, governments would provide assistance to some employees, some kind of areas of assistance. We needed to consider those in the calculation of the quantum of the restructuring provision. We also had to look at assets, the asset side. Do you have impairment of assets consequential to a restructuring provision? And I think the third point on the management steps, the restructuring plan needed to be in place. I think broad stroke restructuring plans or things where the employees do not know about it or do not know what impact it will have on them is not going to meet the requirement. And another point in terms of this, I think again, to some degree, we saw clients trying to, compared to other points in time, trying to put more costs into the restructuring provision when they did qualify. And the point here about the restructuring is, unlike an onerous contract provision where you take into account the costs, the total costs, including the costs that that you are allocating or the absorption of the costs in an onerous contract provision. With the restructuring provision, you only look at the costs that are directly related to the ongoing activity in the measurement of the restructuring provision. Again, the disclosure in IAS 19 is apparent what you need to provide in terms of restructuring. And as I said, look, employee benefits being a big area. People have changed their employment contracts. There have been new benefits. There have been different benefits. There have been paid leave, forced leave, unpaid leave, various kinds of structures we've seen different employees take to manage the impacts of COVID. These got to be assessed in terms of IAS 19, the benefits. Should you be accounting for them now? Should you be spreading them? That's the most significant question. I think for us in this part of the world, if there are employees that are going to be terminated in the near future, this may change the actuarial calculations. In fact, a lot of industries, the actuarial reports which we're supposed to be generating for the end of service benefit may change. I think what's going to happen, I think a lot more liquidity strain is going to be put on the companies, because generally employees would work 4 or 5 years. If you are providing for this on the correct IAS 19 basis, you are projecting what their future salary will be and then discounting it to the balance sheet date. Those valuations would change. Now, I know a lot of times companies in this part of the world may not be all doing an actuarial calculation. They may be coming up with some kind of realization basis accounting whereby they look at last annual salary multiplied by the number of years of service to date. Well, that's not exactly in terms of IAS 19, and depending on materiality, auditors may have accepted it or rejected the accounting treatment. But in terms of that number, in the context of a situation where a company may be closing, may be closer to a real situation, and whereas previously it wasn't. Okay, so those were the sections in terms of assets and liabilities and the impacts that COVID would have on the financial statement. Let's move on to financial instruments. Now, when I've approached the financial instrument section, I think I didn't approach it in those 3 columns in the same way as I've done. What I've been trying to do, and what I've been having the challenge from banks is they've been coming to me with very, very specific paragraphs of the standard and saying, how do we apply these paragraphs in the context of COVID currently? These are difficult times. You've looked at our models, we've spent large amounts of money doing an IFRS 9 implementation just recently, but this historical data that we've got and generated is no more predictive, or it's no longer an effective, what they say, crystal ball for the future. And I think this is a big, big problem. Banks were looking at their models and saying, look, these models are not reflective for various reasons. One, we don't know the future, and we couldn't predict the future. Our models did not anticipate these lockdown things. And because, and I'm going to use this word again, unprecedented events, are our predictions, our macroeconomic, is our forward-looking data appropriate? So what I'm going to talk about, a few things: expected credit losses, significant increase in credit risk. So yes, some people have delayed payments. They have delayed payments. There have been concessions given. Is this moving me from bucket 1 to bucket 2? Is this delays in payment? Is this 30 days past due a significant increase in credit risk where I have to now provide at a higher level? Then at point 3, similar to the issue we had with non-financial assets, we still have the same level of questions on financial instruments. Are we correctly valuing them where I have to do a fair value, whether it's to P&L or to OCI? Hedge accounting issues would be impacted. Own use exemption, might have been changed because a lot of speculators and traders in the market would now, in some instances, have to take physical delivery of these assets which they were speculating, or may have changed their view. And then also the changes to terms of liabilities. I think a lot of people might have gone to their banks and asked for a restructuring of the liability. And the question on that would be, I think the most significant question would be, is that a new liability or a renegotiation or modification of the existing one? Because the accounting consequences would be very different. Let's start off with this little paragraph and how we're going to apply it in the current context. The expected credit losses requires or depends on future economic scenarios. And this is what the modelers work. They try to predict what the losses will be on a portfolio, on your mortgage portfolio, on the borrowings, on your project finance. So what we're going to say, ECLs are measured as an unbiased probability-weighted amount using reasonable and supportable information about past events, current conditions, and forecasts of future economic conditions that is available without undue cost or effort at the reporting date. This may be particularly challenging to do for the economic impact of COVID-19. A lot of people are not willing to predict or understand the future implications of this. People don't know. There's a lot of uncertainty at the moment in the market, in the current context, about everything. And that's why the future forward-looking scenarios may be very, very difficult to predict. Then there's need to look, the way to balance this is provide disclosure. I think what we need to do is provide information about how we are doing this. You know, I think initially the query or the problem in this part of the world was IFRS 9. And I remember, discussing this a few years ago in Qatar. People felt reduces comparability of financial statements because it allowed banks to look at their own risk management policy to decide on the future economic losses. However, the way we could address or bridge that gap is to show your methods and assumptions so that a user of the financial statements could at least understand how the numbers are derived. I think in terms of ECL, in the context of the uncertainty, I think it's very, very important that we need to do proper, adequate disclosure of the nature and the extent of the risks arising from COVID-19. A big question we have from clients is about increases in credit risk. Okay, so people didn't pay me for a month. People, I know he's got a good business, or even on an individual basis, you may have missed a credit card payment, or you might have been out of the country and couldn't facilitate something. Would this cause a significant increase in credit risk? And, a lot of times clients were asking, a lot of our customers may have been 30 days past due, but due to more administrative effects rather than increases in credit risk. Can I rebut the presumption, the 30-day presumption of something being in, significant increase in credit risk, where I'd have to look at the level 2 ECL? And this has been quite interesting. And look, what the standard setter has intervened, and I'm going to share with you what the standard setter would have said, is, and I'm going to draw attention to what the ISB's announcement of IFRS 9 in the context of COVID-19 was saying, and I want to go to probably the third and fourth block here. It says that IFRS 9 does not set bright lines or a mechanism approach for determining when to recognize lifetime ECL. Assumptions and linkages underlying the way ECL have been calculated may no longer. And what we're saying is, look, in the previous days, if you did a restructuring or there were other qualitative measures for significant increase in credit risk, these may no longer be prevalent. And look, another thing is, what they're saying is, to be fair, they're saying in assessing forecast conditions, consideration should be given to both the effects of COVID-19 and government support measures. So if government is providing support, as look, in our part of the world, there was being a complete reprieve on bank charges. And certain people, if you were impacted directly by COVID-19 and you proved to your bank that you were affected by that, there were concessions provided by those banks for you in terms of various things. But what I think is the most important element of the slide is, look, and I think the next slide probably tells you in action, changes in economic conditions should be reflected in macroeconomic scenarios applied by entities and in their weighting. I think there's going to be a lot more dynamic modeling. Things are going to be changing all the time. Models have to be reactive. But also, what I think will occur, and this has been my conversation with the banks, is that post-model overlays or adjustments will also need to be considered. IFRS 9 always considered or allowed management to have a management overlay as long as there was good governance around it. But our anticipation and expectation is going forward, there will be much more management overlay. Of financial instruments will apply going forward. Hedge accounting. Look, there may be changes to hedge accounting, hedge effectiveness and ineffectiveness. If you've been applying IAS 39, which most insurance companies would, you may be ineffective within the 80-125 if things have become significantly ineffective. So there might be issues in hedge accounting. I will be dealing with hedge accounting impacts a little later, and I think we could cover that as well. I see there's a lot of questions on leases, and Brian will be covering that separately in the section. I think the questions around leases are rent concessions and changes in lease estimates. These are significant areas. I think a lot of clients, both from the lessee and the lessor side, have been giving some kind of concession to their customers, saying, look, because the malls are closed, because the retail is low, we are going to give you a payment holiday or reduce your rentals. That's definitely there. Changes in lease estimates. I've been speaking to IT companies, some various companies, they're not considering renewing their head office rentals. And the reason for that is because they've now maybe moving to a work from home model. So there would be changes, or we could anticipate changes in lease estimates, either to lease term from the lessee side, the lessor side, and various other modifications. Time will come. But let's talk about government assistance. I am aware of the time. I'm going to be speeding up a little bit, but please do feel free to ask questions as we go along. Government assistance. Now, in COVID, we've heard a lot that government is going to help us, or government will provide some degree of assistance. And the question is, how should government assistance be accounted for? Now, there is a standard at the moment, IAS 20. Some of you know about it, some of you don't. It's quite an old standard. It's got a few definitions, it's got recognition, and it's got some presentation options. Now, in this part of the world, we've been dealing a lot with government grants because a lot of times government owns an interest in the company. And our question we used to ask a lot is, when is government acting as government versus when is government acting in its capacity as a shareholder? So briefly, I'm going to talk a little bit about government grants. It's not a new standard. And then also, how do we account for newly implemented grants and the presentation of government grants? So look, first and foremost, I think we need to identify government grants. Government grants have a specific standard. Then there's other forms of government assistance, like they provide roads for you, they provide general benefit, and what you should be doing with those. Government grants are in the purview of IAS 20, and they could be monetary or they could be non-monetary grants. The question about when do you recognize a government grant? Well, the recognition of a government grant, it's not made on an arbitrary basis. There is some announcement that government is going to support a specific industry or something if you do certain elements. The requirements or the recognition trigger for a government grant is when you have reasonable assurance that you will comply with the conditions and the grant will be. So there's also what we figured in this, in the aspect of recognition. The timing of the recognition could get complex, and there is judgment required on the timing of the recognition of the government grant. As I said, look, there are various choices. There's grants related to income, there's grants related to assets in IAS 20, and those are presentation issues, but there's also a recognition, timing, and disclosure issue with related to government grants. And in our context, and I think this is very, very important, because government tends to be the shareholder in many of the instances, we need to carefully identify when is government acting in the capacity as a shareholder, as opposed to government acting in a capacity as government. And I think this is very, very important because a government grant, if government provides a non-monetary asset in the capacity as a shareholder, the credit would be to equity. But if it's acting in the capacity as government, the credit is to the income statement in some shape or form. And this is very, very important to acknowledge and notice the difference between those two. We do have guidance and insights, our publication, which has a lovely example on a bus company where we help to identify when government is acting in what capacity. We've also had a number of different application issues which we faced in the market to decide when is government acting in the capacity as government or shareholder, and we need to think about these quite carefully before you make a conclusion on this. I think it might be tempting for some people to take the government grant to the income, whereas it may not be the correct answer if government is acting in the capacity as a shareholder. So management steps, look, you need to monitor your government actions, prepare an inventory of all the government assistance that the company receives and hopes to receive. Determine which standard may apply. There's different standards that may be applying. You may need a grant related to an asset. What we've observed in the UAE, there's been many grants provided to hospitals and other medical institutions in the light of COVID. They've been allowed extra concessions. They've been given grants related to different terminals and various kinds of subsidies. The accounting for these needs to be carefully considered. As I said before, you could have a grant related to an asset or a grant related to income. In a grant related to assets, you can either provide the grant as deferred income, which means you recognize the asset and you have a deferred income. You then depreciate the asset over time and release the deferred income. So if the grant and the asset value are equal, your depreciation and your deferred income tends to amortize on the same basis. Alternatively, you could have a situation where you write off the grant against the asset on day one. That's a math presentation. And if you had a 100% scenario there, you wouldn't have depreciation. So if your value of your asset is 100 million and the grant is 100 million, if you're applying the net approach, you don't have the visibility of the asset at least on the balance sheet. Whereas if it was the gross approach, you depreciate the asset of 100 while simultaneously releasing the income of 100. Grants related to income is recognized as deferred income if the grant is received before the related expenditure is incurred or the condition is met. And in terms of the presentation of a grant related to income, you either recognize it as other income or reduction of the related. I'm going to be closing up in a few minutes. Let me just talk about a few more issues and then we'll move on to the lease adjustments, the leasing section with Brian. Two more questions we get asked, and this is just broadly relating to the financial statements. And one of the questions is COVID-19 an adjusting event or a non-adjusting event? Some of our clients who haven't finished and finalized their 2019 financial statements. And the second question is, look, my business has been significantly impacted. Can I now present my financial statements on a different basis? I think there is an assumption, an underlying assumption in the framework that we are preparing our financial statements on a going concern basis. That means we don't intend to curtail or close our business tomorrow. So none of our assets are at a realization value. But if we have to do this going concern, how do we apply this? How do we disclose it? These are important considerations. So let's start off with adjusting and non-adjusting events. I think what I clearly want to say on this slide is, look, if you haven't signed off your 31st December 2019 financial statement, and the events that have occurred subsequently are not adjusting events. I think if you're looking at the impacts of COVID, the impact of COVID, the lockdown, those events have occurred clearly after year end. So at year end, based on all the evidence we've seen, there wasn't an evidence of any lockdown or the implications of that. So I think the principle or the main principle in an adjusting or non-adjusting event is, did the condition exist at balance sheet? And this is a very, very big question that, clients were saying, especially in the first quarter, is should we be reflecting this as the impacts of COVID is as an adjusting event or non-adjusting? And if the event is clearly indicative of something happening after year end and is material, you need to have a disclosure. And it's not an adjusting event. In terms of going concern, I think going concern, it's important. You need to make the assessment of whether your going concern assumption is still applicable. You need to look at your budgets. You need to make sure that none of your covenants, your loan covenants are in breach. I think the big problem with the breach of loan covenants, and this is a conversation I'm having with a lot of my clients in my restructuring teams, is that some companies may be on the verge or may have been falling foul of their loan covenants. Now, if you're breaching your loan covenant, the consequence of that is your debt becomes repayable on demand. Contractually, at least, it's repayable on demand, which means that your liability is current. Be very, very careful of this. I think clients, when you renegotiate the loan in January or February, it really doesn't help, because the principle of IS1 requires you to look at the contractual situation at balance sheet date. And if you cannot avoid the payment of cash at 31st December 2020, and the covenant has been breached and it requires a repayable on demand, your liability becomes current. And this is an important consideration. So I urge you to look at your loan covenants and see whether you are impacted or not. In terms of interim financial statements, there's quite a bit of words on the slide, but what I wanted to say about this is, look, shareholders, users of financial statements will want to know what's happening. They may have seen your financial statements audited in January. They would need a lot more information. More clients are telling me they're trying to provide more disclosure, sort of take their shareholders, their users through the events that have happened through the assumption. IS34 gives you specific disclosures to be provided in the context. However, various other aspects can be looked at. I mean, IS34 is not only a disclosure standard, there are some measurement principles in IS34, but in terms of the information, I think the most important principle I want to leave you with from this slide is to provide or to join the dots for the user of financial statements. I think that's very, very important. And as we said, investors and other users may be looking for more than the very, very condensed bit of information with one or two very, very small notes. They'd be probably looking for more quality. In terms of other accounting considerations, well, look, we're going to be discussing this. There may be new revenue estimates in terms of variable consideration, etc. They come into play. Changes and restructuring of liabilities. This is a big, big issue for me. I've seen this in a lot of the clients where they're going and not able to meet their current loan obligations and asking for increases in terms, etc. Now, there is a very, very important consideration that needs to be made here. If the terms of your loan change by more than 10% of the NPV, including fees, etc., this is a new liability. And, look, there's obviously a quantitative and a qualitative test. And so 10% test is the quantitative test, but this is something you need to keep in mind. The accounting consequences of a new loan versus a continuation of the old loan does impact your P&L. So this is something you need to give consideration to when you're doing a restructure. Borrowing costs. Companies who are eligible for borrowing cost capitalization, IS23 says, you have to stop capitalization of borrowing costs if the activities are suspended and there's no activity is carried on in the background. So this could be an issue. I think there is a question if you were capitalizing your borrowing costs, you were busy with the development and for a number of months due to the lockdown, you stopped doing it. Should you continue capitalization during that period? Are you eligible to capitalize? And there are elements of guidance in IS23 on that. Another point which we've observed is the impairment of equity accounted investments. So you may have joint ventures and associates which might now be impaired. Apart from picking up the accumulated losses and impairing your other net investments, we also think that there may be significant decreases where you've got to pick up an IS30 impairment on there. And I think that's all from my side in terms of the COVID implications. From an IFRS, as I said, there's a number of aspects which we have impact on. I think we can start off with looking at the balance sheet, focusing on the balance sheet. There would be impairments, looking at liabilities, considering the implications and the impact of onerous contracts, restructuring, and employee benefits. In terms of inventory, contract assets, look at whether those are impaired. In terms of financial instruments, reconsider your expected credit loss, reconsider whether you are moving from level 1 to level 2 because of a significant increase in credit risk. Fair valuation is an issue. Rent concessions, Brian will be talking to you about now. And government grants, if the government is supporting you in all these elements, account for government grants appropriately, and finally, we covered other ancillary aspects like going concern, non-adjusting events or adjusting events, and finally, we covered the aspects on interim financial statements. All in all, I think your response to this is identify the issues, take the corrective action, and I think the best way to bridge the uncertainty is to provide clear and meaningful. Thank you very much. I'll stop the video now, and I think, do we have time for questions, or do we, I've taken this slightly longer. Do I have time for questions, Gopal?
It's Brian. Thank you very much for that presentation. I thought that was an absolutely brilliant overview across all of the different IFRSs of all of the different impacts that our clients could be seeing. While you were speaking, I was monitoring the Q&A, and I think that most of the questions that have come through in the Q&A up to now have actually been about the topic I'm going to talk about now, which is IFRS 16, leases and rent concessions. So if it's okay with Yusuf, if it's okay with everybody, I suggest that I talk about that, I set the framework, and then we come back in 30 minutes and we pick off one by one the questions that have come through in the Q&A up to now.
Perfect. Please go ahead, Brian.
Yeah, thanks.
Brian, I think most of the questions are in lease concession, so I think better to take it after your session now.
Yep, that's great. So I must thank Rian and Gopal and Yusuf for inviting me to be with you today to talk about IFRS 16. I wish I was there with you in person. London, I'm in London today. Honestly, London is horrible. It is grey, it's freezing cold, it's pouring with rain, and I just wish I was somewhere a lot warmer. As I said, Yusuf talked about a whole range of different IFRSs. I'm going to take a deep dive into IFRS 16. Now, I know we've all been talking about leases for a few years. We've been talking about how the new standard requires you to recognise new assets and new liabilities. And I suspect last year there was a lot of focus on implementation and data requirements and system requirements and all of that kind of thing. In 2020, all my discussions about IFRS 16 have focused on one really specific and practical, crunchy question. And that's, what do you do if you're in a lease and the lessee cannot or will not make the payments that it's required to make under the lease agreement? You know, what do you do? What does the lessor do? What does the lessee do? Yep. Now, a lot of these questions have arisen in the real estate space, and a lot of my examples today are going to be about real estate, but everything I say applies equally to leases of aircraft, leases of transport assets, any other kind of lease. We've had some questions already. Keep them coming in the chat. Also, in this session, just to make it nice and interactive, we're going to have a few polling questions as well, so that you in Qatar can interact with me here in London, and that is how I want to start. So I'm going to start with a polling question just to get an idea of how significant this issue of rent concessions is. So I'm going to ask you a question about the UK. It's just a bit of fun. It's just an icebreaker to get us going. So the UK, we've got big COVID issues, but obviously we've got quite an advanced and sophisticated real estate market as well. So my first question is all about what percentage of commercial real estate rents have been paid on time in the UK. So Diala, please can you open the poll for the first polling question? I think it's ticking away there. So this is just a bit of fun. Just make a guess. Tell me how many people you think have been paying their rent on time in the UK. So, Diala, please can you broadcast the results of that poll? Yep, quite interesting. So people who responded were evenly split between the people who were paying 50 to 75%, 25 to 50%, less than 25%. In fact, in the UK, in the first half of 2020, less than 25% of commercial real estate rents were paid on time in the UK. Isn't that amazing? A big, sophisticated economy, a big, sophisticated real estate market like the UK, less than 25% of commercial rents were being paid on time. Astonishing. And I think that really demonstrates, if we move on, that really demonstrates the importance of this issue of rent concessions. You know, you can see on the slide, you could see in the poll, very few people are paying their rents on time. As a response to that, we've seen all sorts of rent concessions, all sorts of agreements, all sorts of changes to lease agreements, lots of side letters, examples of government intervention. Now, from the ISB, we've seen an important bit of standard setting. It's the only really significant actual standard setting that the ISB has done this year in response to COVID. They've introduced a practical expedient for lessees, for tenants. Yep, and I'm going to talk about that. But even just applying that practical expedient, you need to really understand it, and you have to make quite a lot of judgments. And at the same time, that practical expedient applies to lessees only. There's no special guidance for lessors. They just have to apply. The standard as drafted. So let me start with the most basic scenario. Let me start with a question about what happens if there's no rent concession, there's no government action, there's no agreement between the lessee and the lessor to change the terms and conditions of the lease. Let's suppose the only thing that happens is you get to a payment date and the lessee just doesn't pay. The tenant just doesn't pay the landlord. The airline just doesn't pay the aircraft lessor. What happens in that circumstance? Well, if you're the lessee, obviously you still have a liability, don't you? You still have a liability. A lease liability is a financial liability. It's in the scope of IFRS 9 for derecognition. If you haven't made the payment, you've still got the liability, haven't you? Worse than that, you need to check the lease agreement, because maybe you had the liability you started with, but now it's got bigger because perhaps you're incurring additional interest on your late payment. Maybe there are penalties for non-payment. So your act of not paying has not only meant that your liability hasn't gone down, it might have gone up. If you're the lessor, if you're the landlord, if you're the aircraft lessor, you probably have a different kind of question. If you're a lessor in a finance lease, might be unusual in real estate, might be common for other types of leases. If you're the lessor in a finance lease, it sounds like you have an impairment issue. You have an impairment issue. The receivable that's part of your finance lease asset is in the scope of IFRS 9 for impairment. Remember, Yusuf was talking about IFRS 9 earlier. That applies to impairment of the receivable portion. If you have any unguaranteed residual value, you'd also need to think about whether that was really recoverable and think about whether you would have a write-down there. More commonly, in a real estate scenario, if your tenant isn't paying you, then you have a whole bunch of things to think about. You have your basic income recognition to think about. Should you really be taking income either on the lease component or indeed on the non-lease component, perhaps you're providing lots of maintenance and security and other services to your tenants. Should you have income at all on either of those portions of your agreement with the tenant? The second item, maybe you've been billing your tenant and you have been building up an operating lease receivable. In the absence of any kind of waiver or rent concession, that receivable is itself in the scope of IFRS 9 for impairment. What about your underlying asset? Maybe you're the owner of a shopping mall, maybe you're the owner of an aircraft. If you're carrying it at cost, then everything Yusuf was saying earlier about impairment applies. If you're carrying it at fair value, then everything Yusuf was saying earlier about fair value applies. And certainly investment property at fair value, my goodness, markets around the world, those numbers are going down very, very quickly. The first of those things for an operating lessor to think about is income recognition. And one of the issues we have with lessors is whether or not they should continue to recognise income from a tenant if that tenant has stopped paying. And just a really little take the temperature in the room, let's have a quick polling question. And the polling question here is that you're the lessor, you're the landlord, your tenant, maybe a retailer, just isn't paying you, or you know your tenant's business is suffering. Now, what should you do? What should you do? You haven't changed the lease agreement. Should you firstly continue to recognise all of the rent in the agreement as income? Yep. Should you recognise only the amounts you expect to collect, which is the second answer? Or should you recognise only the rents you've actually collected? If things are really bad, should you pull back into a cash basis of accounting? Yeah. So again, this is just to see where we are. And the 45 seconds is up. So Diola, please can you broadcast the results of that poll? And this is such a great result. I'm really, really interested in this. So I think you can all see this. And the vast majority of people, 80% of people, I can tell I'm talking to a sophisticated, prudent audience, because 80% of people said that they would only recognise the rents that are probable to be collected, which is, it's almost like the IFRS 15 answer, isn't it? And that's a really interesting answer, and it's a very prudent answer. And I think because of everything we've done under IFRS 15, we're used to thinking about a collectability threshold. I would say, when you finish this session, when you go back to your desks in your office or in your home, just take a look at the actual words of IFRS 16 and have a search and see if there's anything in IFRS 16 that actually rules out any of these approaches. If you open IFRS 15, it's got lots and lots about collectability. That means that item 2 must be the answer for a non-lease component. Yeah? It's really interesting. IFRS 16 for lessors just brings forward some very old language in IAS 17. Doesn't discuss collectability at all. Yeah, I'm an auditor, but I cannot point to any words in IFRS 16 that rule out approach 1. Actually, it's not something I feel comfortable with, but I can't see the words that rule it out. Yeah. So, if we move on, we started off talking just about the base scenario where the tenant simply isn't paying. And I said that means the tenant still has a liability, the landlord has a whole bunch of stuff to think about. But what if, instead of the tenant just not paying, the landlord and the tenant get together and they agree to change the terms and conditions of the lease agreement. And that's what we mean by a rent concession, an actual change to the lease agreement agreed between the landlord and the tenant. Now, I've seen lots of rent concessions all around the world. Some of the most common forms of those rent concessions are on the slide there. Sometimes, perhaps the tenant just won't pay any rent for the next quarter. It's a pure rent holiday. Maybe instead of paying 100 a quarter, they'll pay 50 a quarter, so there'll just be a reduction. Maybe it's just a cash flow issue for the tenant. So instead of paying any rent for the remainder of 2020, they won't pay any rent, but that amount, that same amount, will be added and it will be an obligation for the lessee to pay that amount in a future year, in 2021 or 2022, when hopefully everything is a bit better. So what's the basic accounting for any of these things? So if I look at the original version of IFRS 16 as published, it says that if I change the terms and conditions of the lease, if I change either the scope of the lease or the consideration due under the lease, that's a lease modification. So let's think about what that means for the tenant, for the lessee first. So I've got a simple example on the slide. The lessee and the lessor, the landlord and the tenant, they get together, they actually change the lease agreement. And it's a very simple change, and the agreement just means that the lessee isn't going to pay any rent at all in the second half of 2020. Nothing else changes. So what does the lessee do? Now, IFRS 16, very specific about this, about how to do modification accounting. It says that the lessee, that the tenant will have to sit there, they'll have to schedule out the revised lease payments, they'll have to determine a new discount rate, they'll discount back the new lease payments using a new discount rate, and that will give the tenant a new lease liability. And the change in the carrying amount of the lease liability will adjust the right of use asset. Now, we've got a publication on lease modifications, and it talks about all of the complexities involved in doing modification accounting. Just think about this for a minute, though. Suppose you're the tenant and you think you've done a good thing. You think you've done a good thing because you have negotiated that you don't have to have this cash outflow in 2020. So maybe you were expecting a credit in P&L. That's not what you get, is it? Because doing modification accounting, the other side of the entry goes to the right of use asset. In a really extreme case, you can get really extreme accounting. Yep. So remember, you're looking at the new lease payments, but also the new discount rate. So what if, since you entered into the lease, discount rates have come down? Now, all around the world, discount rates are falling. In Europe, we're looking at negative discount rates in lots of countries. So your lease payments may be lower, but your discount rate is lower as well. And perhaps that means your lease liability has gone up. Isn't that crazy? You agree a reduction in your lease payments, your lease liability goes up. Your lease liability goes up. The other side of the entry increases the carrying amount of the right of use asset. Maybe, I hate to say this, and this would only be in an extreme case, maybe you've got an impairment issue on the right of use asset because you've increased it. If you do pure modification accounting, firstly, it's hard because you need to work out the new payments and a new discount rate. Secondly, it can give you a really odd answer. You know, you're reducing your lease payments. You could finish up accounting for a bigger liability and even triggering an impairment of the right of use asset. And it's because of those complexities, because of those issues, that the IASB this year has amended IFRS 16, and they moved at record breakneck speed. It took them 10 years to finalise IFRS 16. They finalised this amendment in a matter of weeks. And what they did, they said, this modification accounting, it's just too hard, it's too burdensome for people who've just finished applying IFRS 16. So we're going to simplify things by introducing a practical expedient that very specific and time limited, but will help people get through this COVID situation. And they said, basically, if you meet certain conditions, then you don't have to do modification accounting. And those conditions are on the slide right now. There are 4 of them, and you have to test each modification for its eligibility against these 4 conditions. So the rent concession has to be a consequence of COVID-19, pretty broad condition, but it has to be a consequence of COVID-19. It has to mean that the total consideration in the lease either stays the same or goes down, which is what you'd expect for a rent concession. This concession, this practical expedient, it's time limited. That means that any reduction must be effective before or on the 30th of June 2021. Yep, so if you have something that goes beyond that date, no relief. But if it's before 30th of June 2021, you get the relief. And then finally, there must be no other big changes, no other substantive changes to the terms and conditions of the lease. Yep. So if you can answer yes to all of those questions, you're within the scope of the practical expedient. You don't have to do that complicated modification accounting, but if you answer no to any one of those questions, you're doing modification accounting instead. Yep. Now let's look at what is the accounting if you answer yes to all of those questions and get away from modification accounting. So let me look at some very common types of rent concession. And the first one I'm going to look at is a straight forgiveness of lease payments. So this is the example I had where maybe the lessee, the tenant, isn't going to pay any rent in the second half of 2020. I think the typical outcome, if that's the only change to the lease agreement, that means that under the practical expedient, the lessee reduces the lease liability by the amount of the payments that have been forgiven. Doesn't change the discount rate, so already it's much simpler because you're not changing the discount rate. You just take those payments out of your lease amortization schedule. Yep. Take them out of the lease amortization schedule, and instead of adjusting the right of use asset, you get a gain directly in P&L. So compared to modification accounting, it's simpler because you're not changing the discount rate, and it's a more intuitive answer because you've reduced your rents and you've got a gain directly in P&L. And then I think one of the questions earlier was about when you have the gain, and that depends partly on when you agree the rent concession and partly on whether or not it's conditional. The other thing that might happen, instead of forgiving the rent, you just defer it. So you take some cash the lessee was due to pay in 2021 and you move that into 2022. So you have a deferral. Yep. So the total amount payable under the lease might have stayed the same, but you're going to have a present value impact because you're going to have the same total cash flows taking place at a different time. You discount them back using the same discount rate, and you're going to have, again, a smaller lease liability. Now, the impact on the lease liability is just going to be that time value of money impact because you're still paying the same total amount of cash, yeah? But there will be a time value of money impact. Again, that will reduce the lease liability, debit lease liability, and the credit will go to P&L. So again, it's simpler because you're not changing the discount rate, and it's intuitive because this rent concession is a benefit, and the other side of the entry goes to P&L. Yep, the last one on the slide, very common. You get a few things going on at the same time. Maybe for 3 months this year, you're not going to pay any rent. The rent you were due to pay gets added to the end of the lease when you're going to have an extra 3 months added to the lease term. That's quite similar to a deferral, actually. So you're going to have the same total cash outflow, but it's going to happen at a different time. Discount it back, debit your lease liability, take the benefit of that to P&L. In all of these cases, we're not really touching the right of use asset, as you would have to in a lease modification, so you just continue to depreciate that over the lease term. In the third case on the slide, that lease term might be a bit longer, so you'll have a benefit through lower depreciation in the next few months. So that is lessees. What about lessors? What if you're the landlord and you have agreed to change the terms and conditions of the agreement with the tenant? So I have the same example on the slide as we had for the lessee, and let's assume for simplicity this is an operating lease. Yep. So the landlord is going to get less rent over the remainder of the lease term. The accounting here is a lot simpler, I think, for the lessor, because the lessor, remember, in an operating lease, probably doing straight line income recognition. Lessor in this case just calculates the new amount of the straight line income recognition for the remainder of the lease term. Yep, so it looks at what is the cash it's due for the rest of the lease term. It adds to that any brought forward lease incentive balance, anything like that, calculates a new straight line amount for the remainder of the lease term. So it was doing straight line income recognition previously. It has a bit of a dip, and it carries forward with a new, slightly lower amount of straight line income to be recognized. So a bit simpler if you are the lessor, but it's not completely and utterly simple because I wouldn't be discussing it if it was that simple. So let's think about what would happen. Now, so if it's a rent forgiveness, if it's a flat-out rent forgiveness, 100 goes down to 50. Now, that's fine. Operating lease income used to be 100. Now it's 50, straight line. What if what happens is that instead of there being a forgiveness, the landlord agrees a deferral? Yep, so in this case, we have a landlord leasing a store. It has annual income of 120 a year, and it agrees that the tenant doesn't have to pay as much this year, yep, but it does have to pay that same amount next year instead. So it is a deferral. So the landlord in cash terms is going to have lower cash coming in this year, higher cash coming in next year. And let's do this as a polling question. So, Diala, can you show me the next polling question, please? So my question here, in this fact pattern, if I've got a base rent of 120, operating lease, lessor defers 30 of rent from this year to next year, what's the lessor's income? Option 1, option A, is that I have lower operating lease income this year, matching the cash. higher operating lease income next year, matching the cash, or I say I'm just going to continue with my unchanged income recognition profile. Yep. So just a simple, really simple question. This isn't a forgiveness, it's a deferral. Does a deferral of rent mean, does that introduce volatility into the landlord's accounting? Interestingly, a bit of a split vote on this question. And thank you, Diala, for showing me the poll results. I can see that 36% of people who answered were on the first answer, which was that the income would track the cash, but a slight majority of people, 50% of people, were on the second answer, which was that the income would continue to be straight line. Me, I'm on the second answer. I think I'm doing operating lease accounting. And if I'm doing operating lease accounting and I'm a lessor, I look at my future rentals and I straight line them. Assuming I think I'm still going to receive them under operating lease accounting, I'm not matching my cash. I'm not accounting for the time value of money. So in this fact pattern, remember the lessee has a benefit. The lessee would have a gain in the current year because the lessee is deferring their payment and accounting for the time value of money. If I'm an operating lessor, I have a much simpler model. And for me, a deferral that doesn't change total income doesn't change total income this year either. Yeah. So this polling question, I would give the second answer. If we move on, another very hot topic that has come up again and again and again is perhaps I, as the lessor, I have been continuing to invoice. I've been continuing to invoice my lessee, but subsequently, I decide that I just, I'm going to change the lease agreement, and I'm going to waive the invoices that I've already issued. So I'm actually going to change the consideration in the lease. And this is quite a tricky question, this one. It seems that on the one hand, my previously recognized operating lease receivable, firstly, I have an impairment question, because remember, all along, operating lease receivables are in the scope of IFRS 9 for impairment. And it seems that I also have a derecognition question, because operating lease receivables are also in the scope of IFRS 9 for derecognition purposes. On the other hand, it seems like I have a lease modification as well, because I'm still changing the consideration for the lease. So it feels that to the extent that I've impaired my receivable, it's gone. I should have written that impairment loss off to P&L. So if I've already completely written off my receivable, then I think there are no accounting consequences of agreeing not to collect something I've already fully impaired. Now, what's a bit more difficult is that if I still have a non-impaired amount in the balance sheet, I waive it. Do I take that direct to P&L, or do I spread that forward over the remaining term of the lease? Now remember, impairment must go to P&L in the period. This question about whether or not derecognition goes to P&L in the period or is spread forward over the remaining lease term, quite controversial. I think everybody would agree it's acceptable to spread the derecognition over the remaining lease term. Some people think maybe that derecognition should go directly to P&L as an alternative. To be honest, jury is out on that question at the moment. Personally, I think the impairment must go to P&L. If there is a remaining unimpaired amount to be derecognised. Personally, I'd like to see that going to P&L over the remaining term of the lease. Not everybody agrees with me. Okay, so I've been talking about rent concessions. Now, I've talked about the base scenario, where all that happens is that the lessee stops paying. I've talked about modification accounting. What if there's an actual change to the terms and conditions of the lease? And I've talked about what happens if that falls to be accounted for as a modification. And then for lessees only, I've talked about what would happen if this new practical expedient, the biggest thing the ISB has done in response to COVID-19 this year, what would the accounting be if the practical expedient applies? Now, I hope you found my presentation kind of helpful. Everything I've talked about, more than I've talked about, is available in our publication on lease modifications that I highlighted earlier. And just this year, just a few months ago, after the ISB amended IFRS 16, we issued a brand new publication, 50, 60 pages of really specific guidance on accounting for rent concessions, also available for you to download and refer to. Yep. So IFRS 16, very hot topic this year. That's the end of my presentation. I know we had some questions during Yusuf's session. We could well have had more questions while I've been speaking. So let's talk a bit about the questions we have received. So I'm not sure if Diala or Rian is able to display the questions on the screen. Okay, so I can see the questions
in Q&A.
Okay, I can see the questions in the Q&A in the chat. So I'm going to try and deal with as many of these as I can in the next 10 minutes or so, and then we will take a break. I think I'll deal with the questions as they came in. So the first question was about a rental waiver from April to June introduced by the government, and there was some management decision as to what to do. Now, I think government actions need to be evaluated on a case-by-case basis, and because I don't know the particular government action that was taken, I'm not sure I can comment in detail. But let me tell you some of the things I would think about. One of the questions I think that comes up when a government is doing this kind of thing to support tenants, to support lessees, I think there is a question, is there a government grant? Is there government assistance? Which is one of the things that Yusuf talked about earlier. So if the government was making payments on behalf of the tenant, that feels like it would be a transfer of value from the government to the tenant, could be the government grant. Conversely, if the government just passes a law, just passes a directive telling the lessor to not collect rents due from the lessee, then that is probably, in itself, not a government grant. And I can see now that the other questions are up on the slide. Let me see. So the first one, how to treat a loan repayment where the period has been extended without concession on interest payments. So I can see, Yusuf, you're back with us now. I can't tell from the question if that's intended to be a IFRS 9 question.
IFRS 9 question. It's linked to a loan. I'm presuming the person wants to know the loan repayment period. So you were supposed to pay the loan in the end of 2021. They've deferred the loan repayment period to 2022 or something like that, or some later period. and they're asking you to continue to repay the interest on that. So look, it depends on the type of the loan. You always do a net present value calculation of this. If it is a bullet repayment, it could have an impact on your net present value of cash flows, and there could be a slight deferral of cash flow. There could be an impact. If it's not, if there's it's like a mortgage or reducing balance, then the risk of impairment isn't there. So, and by nature, if your question is the extension of the period by nature a significant increase in credit risk? Typically, we used to say that qualitative factors like extension of terms, would normally push us into a bucket 2, especially if it was linked, the restructuring of the payment terms will link to a credit event. But obviously, in the COVID context, you need to reconsider. So a few points. I think how to treat. I think I'm looking at it 2 points. I mean, is there a significant increase in credit risk? Normally, yes, there would be. And secondly, if your question is related to the cash shortfall, there could be a cash shortfall if this was a bullet repayment scenario. And you need to do the cash shortfall calculation on the elements there to see if there is a cash shortfall. But also there is another factor, if it's a floating rate or a fixed rate loan. I mean, I expect on a fixed rate, you could have a different scenario. I hope that answers the question.
Probably they might like to know what is the borrower's perspective as well. I'm just linking the second question to the first question. So is there any change on the borrower's perspective as well?
Okay. So from the borrower's perspective, quite interesting. So the borrower, the liability, so if you say that the liability scenario, you would do 2 tests, on the liability. So obviously from the lender, it's an ECL question, and if you're deciding, is there a significant increase in credit risk, or is there a cash shortfall that needs to be computed? Whereas from the liability perspective, you're going to do two assessments, qualitatively and quantitatively. Is this a loan modification, or is this a new loan? If it's a new loan, IFRS 9 says you treat this at fair value on initial recognition, new effective interest rate going forward. If it's a perpetuation of the old loan, your original effective interest rate continues to apply. Now, without numbers, I'm just looking at this at face value. So you still accruing the same amount of interest. There doesn't seem to be a qualitative. I'm making a few assumptions here. There's no qualitative change in the loan terms. It's the same bank. I doubt you'd meet the quantitative test or the qualitative test. So what you would do is continue to accrue on the amortized cost basis using the original effective interest rate. Would there be a gain on this? Per se, I don't think there'd be no. I think you're going to continue to account for that concession using the original effective rate. And it would be, any benefit, if there is any, would come through through the effective interest calculation. So yes, the lender and the borrower have different treatments. Obviously, lender, it's an ECL question. Borrower, the only question would be, is this a new loan or not? Is this restructuring a new loan? And very, very simplistically, it seems not, but obviously the assessment must be done. The auditor will ask you, have you looked at this quantitatively and qualitatively? And for the liability side, that 10% test still exists. It's an interesting. I don't see any other fee points or anything added to the extension of terms. So no, it's some kind of concession, but it would be accounted for through the normal effective interest rate method.
Okay. Thanks, Yusuf. So our second covers off the the first two questions. The third question I was attempting to answer earlier. I think the question is two questions really. What if the waiver or moratorium was granted by the government? Well, there, I think you have to think about whether or not there is a government grant. I think if the government is actually paying the rent, then that could quite possibly be a government grant. If the government is not itself transferring any resources to either the lessor or the lessee, then it's probably not a government grant, and you really have to focus on whether or not there's actually been a change to the terms and conditions of the agreement between the landlord and the tenant. If the waiver or the moratorium has been granted by the lessor, so it's an actual change to the terms and conditions of the lease agreement, then everything I said in my presentation applies. The lessee has to think about, is it a lease modification? Are they eligible for the practical expedient? And then the lessor is just stuck with modification accounting. And if there is an absolute forgiveness, then for the lessee under the practical expedient, that's probably a gain today. For the lessor, they probably have lower operating lease income for the remainder of the lease term, so that's going to give them a dip in their operating lease income to be considered. And I think perhaps question 5 on the slide, which asks about IFRS 16 versus IAS 20 is related to that. I think if I am the lessor and if I'm either the lessee or the lessor and I have a contract with government and there's a variation to that, I think I need to make quite a big judgment actually. If the government is party to this variation and it's providing me with a benefit, irrespective of whether I'm the lessee or the lessor, I really need to think in the circumstances of the particular jurisdiction, is that essentially a contractual change? Because if it's really just the government acting like any other contracting party would do, and they've modified my lease agreement, then I think everything I talked about in my session would apply equally. On the other hand, if it's the government doing this, perhaps not just for me, but for the wider population, if it's a transfer of resources, all of those things could be indications that this is actually a government grant. So I get that question a lot, particularly from this region, and I'm afraid all I can really say is it's very judgmental, and it can vary from country to country and from case to case. There's a question I've seen a couple of times in the chat, which isn't on the slide yet, and I'll just address that because I think it's a really important kind of practical question. And I can see that in the chat, a few people have been asking exactly when do you account for these rent concessions? You know, this ties back to some of the things Yusuf was saying about post-balance sheet events. So suppose at the end of June, the landlord and the tenant are discussing a possible rent concession, but the contract isn't actually changed until September. Now, a lot of questions in the chat are really about this fact pattern. What if at the reporting date I'm in negotiation, but the contract isn't changed until after the reporting date? So if I'm the lessee, then the fact that I'm in negotiation has no impact at all on my lease accounting. If I have a contractual obligation to pay rent to the lessor, that obligation is a financial liability. It's subject to derecognition under IFRS 9, if I'm in discussion, but I haven't signed on the dotted line, I still have to account for that contractual liability at the reporting date. If I'm the lessor, then again, I don't have a lease modification yet because I haven't changed the terms and conditions of the lease. But if I'm the lessor, I almost certainly have a really big impairment question. If I am not expecting to collect some cash flows that I'm due to under the terms and conditions of the lease, that's almost certainly an impairment question at the reporting date. So again, I've seen this question a lot in the chat. If at the reporting date I'm in negotiation, that is not a lease modification. I have a lease modification only when it's signed up and agreed. But if I'm the lessor, I may have an impairment issue. My goodness, it could be quite a big impairment issue. So Yusuf, I think I saw you coming back in, and I wondered if you were planning to talk about question 4 on the screen about determination discount rates.
Due to COVID-19, yes. I'm going to look at question 4, and the question is, how do you determine a discount rate due to COVID-19? And I think that depends mainly on the standard we're looking at. In the employee benefit standard, it would be very different to the discount rate you would use for an impairment calculation or an impairment question under IAS 36. I think my initial reference was on IAS 36, and let me talk about the IAS 36 discount rate for impairment first. When you're doing an impairment test, I think the discount rate IAS 36 says you need to look at you need to take into account the time value of money, number one, and then you need to take into account risks pertaining to the asset which are not adjusted in the cash flows. And then it goes further in IAS 36 to say that, you look at, your starting point would be sort of a weighted average cost of capital for a similar entity in the similar industry. So that would be your starting point. Now, in the context of COVID, we're saying, look, maybe cash flows, and I think what we put on the slides is due to the uncertainty of the cash flows, we'd be expecting to see adjustments in the discount rate to take into account the additional risk. So, if you have less predictability, less certainty around the cash flows, the growth rates, you would typically expect to see an adjustment for those risks in the discount rate in an IAS 36 context. To bring that question back to an IAS 19 context, yes, there's a lot of elements to be discounted in an IAS 19 context. The IAS 19 definition of a discount rate is different. It's looking at, the deep market concept for bonds, and what is that value for the corporate bonds and for your actuarial assumptions. So that would be a very, very different number. So I think that would be something factual. You'd have to derive that from the market, whereas the IAS 36 discount rate would be something contextual. It would be very, very different. It would change from asset to asset, and it would be based on the uncertainties of the cash flows that exist in that calculation.
Thanks very much, Yusuf. I can see we've had a lot of questions. I think we've talked about the questions that we pulled out onto the slide. I'll try to answer a few additional questions I can see in the Q&A. And I know that we're going to complete the session later on with a further Q&A. So my suggestion, Rian, is that we take a break now, and I'll hand over to you to talk about what will happen next.
Thank you, Brian. Hello, everyone. We will now be taking a 5-minute break. We request that you please do not log off. And there will be a timer on the screen to give you an idea of how long we have left until we start this session again. Thank you very much. I'm looking forward to seeing you again. Hello, everyone. Welcome back. I will now be handing over the session to Yusuf. Thank you.
Thank you very much, Rian. Just to continue on the COVID context, and we're going to be looking at some of the IFRS 15 considerations and the implications on revenue with contracts with customers. Now, look, we are a number of years into the application of IFRS 15, and IFRS 15 is based on contractual rights. Now, what does occur, what has occurred, we've seen from the COVID situation is there has been questions on enforceability of contracts, on entitlement, on settlement of discounts, on various elements of contracts with our customers. So there might have been formal concessions, there might have been informal concessions, and specifically in the construction industry, at least in the Middle East, we've seen a lot of defaults and recent news about companies unable to fulfill their obligations, going into liquidation. So I think the consequences and the of whether myself as or my entity, in terms of IFRS 15, do the contracts still exist? How should I react and approach the COVID situation is more important than ever. I think that what we want to cover in this COVID 19 or IFRS 15 session is three aspects. I think the first issue we'd like to ask is, if you look at step one of the IFRS 15 steps that we have, step one says identify the contract. And what we look for due to COVID-19, can companies still abide by the contractual terms? One of the requirements for having a contract is that both parties are still committed to the obligations under the contract. And the question that arises in the context of COVID-19 is, due to this uncertainty, are the contracts still enforceable? So I think the first point we'd like to consider in terms of contract existence with regard to new contracts, we're asking you, consider carefully if they pass this contract existence test. Now, in terms of contract existence, before we go on to another point, I think, look, in the elements regarding the existence of the contract, obviously one is commitment of the parties, one is the enforceability of the contract, and also the probability of receipt of funds. Now, in terms of the probability of receipt or the collectability of revenue already recognized, that would be a different question, and that's probably more of an IFRS 9 question. I think what we're focusing here in this question now is, I've got these contracts with my customers, and I'm trying to enter into new contracts. Will there be fulfillment of these contracts? Do these contracts meet the recognition requirement? I know if you recall in IS 18 or in the framework generally, we used to only recognize a revenue contract if it is probable and the amount could be measured reliably. IFRS 15 has these concepts of enforceability, probability, all built into this identification of the contract step. So I think what you need to do is, in terms of new contracts, in the light of the current situation, you would have to make an assessment as to the existence and the enforceability of the contract. And I think where I can give an example of this is, look, many people may be claiming, going to a hospital and claiming for medical aid claims, which are maybe COVID related, and they may not be covered under that policy. The question would be, is that contract on the revenue side by the hospital actually enforceable? Do they have a commitment on that? With regard to existing contracts, look, these contracts already met the recognition, the step one criteria, but you now need to reassess whether the existing criteria continues to be met. Is there a significant change in facts and circumstances? Have the parties lost that commitment to transact with each other? Have the laws changed? Has the context changed that the enforceability of this contract could be called into question? Now, the consequence of this is, if that existing contracts become unenforceable, or the parties are no longer committed to this, or something of that sort. At that point, you would stop recognizing revenue on that because you're failing an essential part or essential step of the revenue recognition. The second point is on revenue recognition over time. Now, a lot of our real estate companies have applied IFRS 1535C, where we are on off-plan sales of property, you're recognizing revenue on a percentage completion basis. Now, a lot of the developments have continued in development. Some of the developments have been suspended. Some of them have been completely terminated. Now, to get into IFRS 1535C, and this is to get into the percentage completion basis, which was a very, very controversial topic in the Middle East, we went through a very, very detailed process where we had to read the contracts of sale of our real estate clients to understand whether the real estate companies qualified for the percentage completion under 35C. And these were typically in these apartment situations, off-plan purchases. So this wasn't a 35A, which allowed you percentage of completion based on service, on the consumption of the service as the service was performed. It wasn't a 35B where it was on an asset owned by the customer. It was a 35C. And in 35C, just to remind you, the 35C requirement in IFRS 15 says you can apply basically the percentage completion or revenue recognition over time if the asset has no alternative use and there is an entitlement for the value of that over time. And that's effectively both those requirements, the no alternative use and the entitlement needed to be met. Now, if the right to payment in the current context ceases to be enforceable, we then have an issue. And then the criteria of 35C fails to be met. And look, in our context, I even fear that perhaps in some cases, a client may even change the alternative use concept. But I think what I'm focusing here on is the accounting consequence of the situation where the entitlement to payment may not be enforceable. Now, this year, we haven't yet tested it with the courts. We haven't tested with the lawyers. But the question would be, in this current context, if a developer has completed X percentage of this, does he have an entitlement to collect costs plus margin, not just costs only? It's costs plus margin on those developments. And if that has failed, then the eligibility for the percentage of completion also fails. So this is something you need to have a look at. Have a read through your contracts and understand whether those requirements have been met. In some cases, we've come across situations in only a force majeure, in a force majeure event where, for some weird reason, then you're only recovering costs. So if you're only recovering costs, if that situation had existed from the inception of the contract, it wouldn't be equating to a situation where you are entitled to payment for. I think the message I want to put over here is, look, relook at your contracts, relook at the existence of the contracts, question, have a discussion with your legal teams over the enforcement of contracts, and whether that enforcement is under question, there may need to be a reassessment of those. I think the consequences of that reassessment could be, if the contract doesn't exist, you're stopping recognizing revenue. Or if you've been applying a percentage completion and the payments are no longer enforceable because there's some degree of concession, or the government is saying, look, people are in troubled times, you're not going to leave people without homes or something of that sort, you may then have to consider changing from a percentage completion to a point in time recognition. The other point is, look, there may be contract modifications. Now, contract modifications are changes to the contract. Now, there are different types of changes. Some changes may change the scope of the work, or may change just pricing. Or you may have a situation where both of these elements are changed. Look, there is guidance. We look at various situations of guidance when we look at additional products or services. or how do we account for the changes? Now, various situations give rise to different outcomes. Now, in our publication Insights, which I'm sure Gopal and Yusuf can share with you, there's a flow chart we go through to try and help you with the assessment of how to account for a contract modification. When additional goods or services are added, when they are not added, how do you account for this prospectively? How do you do the changes in the contract? I think the message I want to leave you with from the slide is relook at the contract enforceability, have a discussion with your legal teams, have a look at the situations or precedents in law that have happened where the government has enforced or not enforced certain situations on your customer that could affect the contract enforceability. In terms of revenue estimates, so look, IFRS 15 introduced this concept of bringing in or accounting for variable consideration, and the variable consideration was accounted for and brought into the measurement of revenue based on a most likely, or the more predictive of the most likely outcome or an expected value depending on the situation. Now, this variable consideration could be increases in revenue or could be decreases in revenue, through discounts, through rebates, whatever the case may be. And I think one common example could have been settlement discounts or something like that, which causes revenue to vary. Now, what we need to do or look at in the current context of IFRS 15 in relation to COVID is have those elements of variable consideration, which inherently was an estimate, changed. Now, obviously, when it is additive, when your variable consideration is additive, there is a further limit or cap or constraint, on how much additional revenue you could be recognizing. So, for example, if you had a situation where you had an incentive bonus for completing construction early of 10%, and you believe that it's most likely that you are going to do that, you were still constrained by what was called in IFRS 15 the constraint of what would be highly probable will not result in a revenue reversal. So I think now in context, what you need to look at is, look, has the constraint come into play? Are those estimations of variable considerations still valid? Do you have penalties in place? Penalties, incentives, as I said, it could be positive or negative. Variable consideration in a very simplistic concept is anything that changes or varies the amount of revenue I receive. And these elements could have changed due to changes in estimate. Look, variable consideration inherently is an estimate, but the changes in circumstances could cause you to lose, to reassess or reevaluate. Changes in variable considerations are not modifications on their own, they are changes to the amount. Also, what you need to look at further is on the standalone selling price. Now, look, in terms of step 4, or step 3 and 4, the revenue cycle, you'd have to allocate certain prices to different elements of the transaction. And look, that allocation was based on different market values on a relative, and there were different techniques to determine the standalone selling price. You don't actually do a after contract inception because at the date of pricing you've allocated the deal, the customer has agreed to the transaction, you've done your pricing, you've booked your cost of sales. And I'm thinking of these good old handset examples that we used in the good old days on the telcos. But what you need to do is look on new contracts. It could be very, very different to the legacy contracts you may have offered because the older contracts may have had a different standalone price. I mean, I'm thinking also of my own Skyward miles or my Voyager miles or whatever the case may be. In the current context of generating those miles and consumption of those miles, it could be very, very different. For the simple reason that the current price of the flights are very, very significantly different to the price of the flights before. And perhaps there's a difference in that from an airline. Finally, in terms of overtime revenue recognition and in terms of the revenue estimates, I mean, look, your cost to complete may change because of delays, because of changes in labor costs, delays in materials, all those elements. And what you need to do in your measure of progress, whether it's an input method, output method, but specifically I would say this would impact the input method, you need to make sure that your measure of progress is accurate. I mean, if your expected costs increase similar to the IS 11 situation, we used to have a lot of adjustments which we'd have in terms of contract costs changing and varying over time. This could impact our revenue recognition going forward. Finally, on revenue, as we discussed in the previous section, impairment or recoverability of revenue cycle assets. So, I mean, we're not talking of the non-financial assets, we're talking more of the current type of assets. And, these could be inventory, contract assets or receivables, and contract costs. Now, I think last year in our example on IFRS 15, we showed you a very, very detailed analysis of how do you define what is a contract asset versus a receivable versus an executive contract. And it all depends on billings and the contractual rights, that exist in terms of how you perform in a contract. But if you have output, obviously that's inventory. The guidance on inventory sits in IS 2. This is not an IS 36 impairment test. So it's not a discount rate, value in use, fair value less cost to sell assessment. I think what you're looking at in an inventory context is, we always have receivers policy, inventory is measured at the lower cost net realizable value. But what is net realizable value? It's the estimated selling price less the cost to complete and the selling cost. It's a different concept to fair value. It is your selling price less the cost you have to complete and the selling cost. And the idea behind this inventory write-down, which incidentally is reversible, it can be reversed in future, like all impairments, but there are limitations to that reversal. But net realizable value is not a market value. It is a value. It allows you to, or it requires you not to carry your inventory at the wrong values. And look, what we're seeing or what we're understanding is in some cases, because of a delayed supply chain or delays in materials reaching the ports, etc., there may be increased costs because of these increased costs, or increased costs to complete, or increased selling costs. So all those elements may come into play and could impact our net realizable value. And as I've seen in cases that we have had here, especially in relation to some of the industry where they had edibles, these items may just be pure obsolescence or reaching expiry because of no way to get out. So look, I think inventory write-downs may become an issue you need to look at. Now, on to the next point about contract assets and receivables. These are going to be tested for impairment under IFRS 9. Now, what does that mean? That means you're going to be having to look at a forward-looking measure. You've got to think of what has happened in the past and try to predict what the losses are going to be in the future on both receivables and contract assets. There are differences between the two, and as I said, I think the difference or the fine line on the receivable is where you have a legal right to collect. So you effectively, in an oversimplified manner, you've got a billing out there, and that billing is legally binding for you to pay. Whereas a contract asset is you've done the work, but you haven't established the legal right to pay. But as I said, on both of them, although one would be a receivable is more akin to a financial instrument, whereas a contract asset arises out of IFRS 15, both of them are subject to this forward-looking macroeconomic projection. Now, why is this relevant? And as we discussed in the IFRS 9 section, look, the macroeconomic outlooks could be different. I mean, the questions that people are asking is, what if there's a second wave? How do we know these guys are going to pay? People are struggling. There's cash flow issues. And, we're waiting to see what kind of government help will come into the sector, etc. Typically in different industries, we've seen this. And look, what I'm saying is specifically, we are having challenges in the construction industry because of some of the large failures in some major construction companies that have happened. The last point on this slide we'd like to talk about is contract costs. Now, IFRS 15 gave us a good, interesting concept where contract costs, and these were typically commissions in our market, were capitalized. And these were, it was defined in the standard as incremental costs of obtaining the contract. So these commission costs, or if somebody sold a property and you pay on your behalf and you're paying them a commission, you typically would capitalize that and amortize it over the period of the contract. Or this could also refer to capitalized fulfillment costs, so costs you have incurred on the contract which are recoverable. Now, in the current context, your question here on these contract costs is, are they recoverable? You've got to subject them to an impairment test which exists in IFRS 15, not in IAS 36. You compare effectively the remaining amount of consideration you expected to receive and the costs that have not yet been recognized as an expense. Also, you've got to think about the contract period. Look, is the contract period longer, shorter? Do you still have to amortize? See, contract costs, although they exist, they're capitalized on day one, subject to eligibility, and then they need to be amortized over the period. So also what you've got to be careful of is there might be a double whammy. There may be accelerated, there may be impairment, or there may be accelerated impairment, amortization in respect of the contract. Okay, so that ends the section on revenue and the consequences specifically on revenue. Just to recap, as I said, the 3 points we need to be looking at is the enforceability of the contracts. Are our contracts still enforceable? Are the other parties still committed? On existing contracts and in new contracts, there are different considerations. On the new contracts, we also need to consider the probability criteria as well. Second point was variable consideration. So circumstances that may have driven our probabilities in variable consideration could have changed, and these are changes in estimates that need to be accounted for. And finally, we discussed these issues with relation to revenue on. Sorry, I'm just losing that chain. Sorry, on revenue. In relation to contract costs and the amortization of that, and impairment. So revenue cycle assets may need to be impaired, inventory, contract costs, receivables, and if we have any contract costs or fulfillment costs that are capitalized, there may be a risk of impairment and accelerated amortization. The next section I'd like to cover, which is completely different issue, but links, it's not COVID related, but it is a very, very pertinent and relevant topic. Now, some of our banks have come to us and asked us questions around the IBOR reforms. But what I thought was necessary is first to explain to you the context of that. What is this IBOR reform? And then what we've noticed the ISB do is they've decided to give first an immediate kind of relief, and then in the second phase, gave more detailed guidance on relief and what needs to be done. So the way they've structured it is we've called it phase 1 developments and phase 2 amendments. The phase 1 amendments are effective 1st January 2020. The phase 2 amendments are effective 1st January 2021, but are available for early adoption. But now, what is IBOR reform? And I think this is the more important question. And I want to talk about IBOR reform and then tell you which areas of accounting does it have an impact on. So people who link things to IBOR, obviously they would be impacted. Now, who links things to IBOR? Obviously, a lot of borrowings may be linked to IBOR. In some cases, but I haven't experienced this in the local market, you may have lease payments linked to IBOR. Or some kind of borrowing rate, and whether it's a local borrowing rate or LIBOR. Most commonly, especially when I've been seeing in the Middle East over the years, we've had LIBOR-based contracts which were based on the London Interbank Offer Rate. So Your transactions may be structured as this, as a variable rate. It has been used as a point of reference. So there has been IBOR reform. This is an economic consequence. And this economic consequence would impact all the elements of accounting that have an IBOR element to it. So look, let's start off where the IBOR reform started. There was a LIBOR scandal, and I think this is where probably everything started. And essentially what that LIBOR scandal was about is bankers were reporting false interest rates, and the view was they are manipulating the markets to boost their own profit. So there was this massive LIBOR scandal. It was in the news. People were manipulating the rate. What is the LIBOR? It's an offer rate, but it was a hypothetical offer rate. And the problem or the issue with the LIBOR rate and the criticism was it wasn't necessarily based on actual transactions. It was a rate, and this is why there was the scandal. It felt as if this rate was sort of rigged, or it wasn't based on an actual transaction. So what happened? In 2014, the Financial Stability Board recommended the reform of these rates, such as the interbank offer rates. And what they said effectively is authorities in jurisdictions, you need to reform your interest rates, and you should come about with alternative benchmark rates. And the idea behind these alternative benchmark rates should be closer to something that is more market-driven, rather than something that is not based on actual transactions, that is just between banks. So I think the impact after the Financial Conduct Authority, the benchmark LIBOR is expected to end after 2021. And look, there's different, and if you look at the various literature around this, there's just different rates that different countries will be moving to or transitioning from LIBOR. So good. This is the issue about LIBOR. LIBOR has been used as a basis of transactions. It's a pricing mechanism. So normally pricing doesn't affect accounting. Now, why would a pricing basis affect accounting? Is a question that we'd ask. So let's start by thinking that, look, how are these things impacting? What items are impacted? And what items would then be affected from an accounting perspective? So look, if you've got an IBOR used, where would we see IBOR used? Floating rate loans and bonds. There may be loans, I can be the lender, I could be the borrower, which are based on IBOR. Or bonds that are based on IBOR. Again, I could be the lender or the borrower. It could be my financial asset or liability. And if I was on the other side, I might have a swap, which may be a hedge or maybe a speculative instrument that either swapped my fixed for floating or floating for fixed, depending on whether I was doing a cash flow or a fair value. Or I even may have had cross-currency interest rate swaps, where I was having a loan in one currency, which would swap to an interest rate in another currency. Or, as I said, there could be lease payments or variable lease payments, which were based on LIBOR, IBOR, etc. And these variable lease payments, if you recall from IFRS 16, variable lease payments based on sales or usage are not included in the liability. However, lease payments that are based on an index or were indexed could be or would be included in a variable lease liability. From an accounting perspective, what does this impact? Well, look, if now somebody is changing something in your contract, the question that you're going to ask is this a modification of a financial instrument? Now, the impact of a modification of a financial instrument is vast. And as we discussed, and I've seen some of the questions earlier, is this modification, how do I account for the modification? Is this a new instrument? If they tell me it's no more based on LIBOR and it's moved to some other rate, is this a new instrument or not? Do I have to do a new fair valuation? Do I now need to look at, or do I do some kind of just cumulative catch-up or something like that? What if I had a fair value hedge? What's a fair value hedge? It's a hedge where you are, and let's look at probably a loan, where you are paying a fixed rate on the loan, and you are concerned that, look, you're not exposed to market rates, so you take out a swap that gives you an exposure to variable. Or you could have a cash flow hedge. What's a cash flow hedge? Is you have a loan which is charging you a variable rate of interest, but you want predictability of cash flows, so you go and fix the rate of that. And look, the accounting consequences of these are different. As I said, the accounting consequence of a fair value hedge, if you apply hedge accounting, and remember hedge accounting is optional, if you applied hedge accounting on a fair value hedge, you'd measure the derivative at fair value and you'd measure the hedged item or the hedged item at fair value. So basically you'd have an offset of the derivative against the portion that you fair value. So you've got a mixed measurement model. So you'd be measuring the loan partially at amortized cost and fair value. But the idea behind both fair value hedging and cash flow hedging is, if you do the hedge accounting, is to take away the noise of the derivative. In a cash flow hedge situation, the mark to market of the swap would be taken into equity or parked into equity and would not be affecting your income statement. So these are the accounting areas that could be impacted. So I think what you need to do is have a look at, if you have floating rate loan swaps, cross-currency interest rate swaps, lease payments that are indexed to a interbank offer rate, have a look at these, and these requirements or reforms apply to you. Now, what did the ISB do? As I said, there were two phases. In phase one, what they did, they just gave some guidance. They allowed you to make some assumptions. And I've used a new abbreviation there. ABR means alternative borrowing rate. So we said, look, you're going to move from IBOR to an alternative borrowing rate. What does this mean for you, and how do you apply it going forward? Now, in the subsequent slides, I'll explain this to you in some detail, but all I'm saying, it allows you a bit of concession in this transition. The objective of the ISB is to help you. It's to help you, it's to help you, allow you to account for this change that is happening on a global basis when people are moving away from IBOR. It also provides temporary exemptions to specific hedge accounting requirements because of the uncertainty arising from the reform. So that was the phase one. Recently, in August, they completed the phase two parts of the reform and gave a little bit more guidance on different aspects, on changes to contractual cash flows, on hedging relationships, etc. And we'll discuss these in detail with you. So let's start with phase one amendments. What did the phase one amendments do? These were simple, quick amendments. They amended IAS 39, IFRS 9, and IFRS 7. IFRS 9 deals with recognition and measurement. IFRS 7 deals with disclosure. But some people are saying, hey, why is there IAS 39 here? Surely IFRS 9 is effective from 1st January 2018. Why is this still on the list here? Now, insurance companies, as you may recall, were allowed a deferral. They were allowed a deferral of application of IFRS 9 to the year that they applied IFRS 17 in there. So I think this was a very, very important, that a lot of insurers would still be applying IAS 39. And some entities may have elected to apply the hedge accounting requirements of IAS 39 by choice, even in their IFRS 9 adoption. But I think this specifically in IAS 39, and we've seen this with a number of our insurance companies who did not early adopt IFRS 9 or didn't adopt IFRS 9, because they said, look, let's do a once-off application of two new standards, IFRS 17, which focuses on the liability side, and IAS 39, we will move, or we'll transition to IFRS 9 when we fix up the liability side. So we'll fix up the asset side. Typically, the assets would be impacted by insurance companies. But getting back to phase one. So what does phase one do? Look, it's a whole lot of concessions. It's a whole lot of concessions that help you with hedge cash flows. If you looked at IAS 39 and IFRS 9, for a forecast transaction, there was a highly probable requirement. So there was this highly probable requirement. Now, all of a sudden, your contract has changed. Hey, is this highly probable requirement met? The wording in the amendment says assume. Assume. It takes away that hassle of doing detailed technical analysis, trying to make a judgment, trying to argue, saying, hey, assume that the interest rate benchmark on which the cash flow are based is not altered. Make that for the highly probable requirement. Don't say the highly probable is not met. Assume that when you are changing from LIBOR to some other rate, that, hey, look, there's nothing else. Assume that the benchmark on the cash flows is not altered, which means you can continue doing your hedging. In terms of prospective assessments, you make an assumption, or it's a concession. So they're allowing you some kind of technical reprieve. Don't go through this debate. You are going to get yourself tripped up. Make an assumption. You make an assumption that there is still a relationship between the hedged item and the hedged instrument. So although your contract may change the pricing basis from LIBOR to something else, you make the assessment. The prospective test is still required, whether it's IAS 39 and IFRS 9. You still have to do a prospective test. You just got to make sure the terms match, etc. But hey, don't worry about it. Make the assumption that these things match. So people used to do the critical terms matching. Assume they match. It's just a change in the basis. Do not get into the technicalities. You can make the assessment on that. If you were doing a retrospective assessment, which people who are still adopting IAS 39 would do, you needed to make sure your hedge is effective within the 80 to 125. So, and what does that mean? That means within 80 to 125, you continue to do hedge accounting, but you book the ineffectiveness in profit or loss. If your hedge was 79% effective or offsetting to a degree of 79, you stop hedge accounting. It was a rule. This saying, hey, wait a minute. If you go ineffective because of the impact of the reform, you don't have to discontinue hedge accounting. So that's that. When do I stop application? Prospectively at the earlier of the resolution of the uncertainty of cash flows or discontinuation of the hedge. That's when we stop applying this phase one. If the uncertainty of the cash flows is over, I don't have to apply this, but I can continue to do my hedge accounting, or I discontinue my hedge. End of story. I apply the normal rules. So, what do I need to disclose for bench? And this is effective this year. Tell your users the benchmarks to which your hedging relationships are exposed. Is it IBOR, Euribor, SIBOR, if you're exposed to whatever market you're in? The extent of the risk exposure that is directly affected by IBOR reform, how the transition to the new rates is being managed. So this is useful information. You're telling your user, hey, look here, this has happened. This is an external thing that is driven by the Financial Stability Board, and this is how it is impacting me and my financial statement. With a numerical, the numericals may get lost somewhere in the balance sheet, but this disclosure here helps the user understand the extent of the impact of the IBOR reform on it. Now we get to the phase 2 amendments. Now, what are these phase 2 amendments and what do they mean? And these amendments are a little bit broader. They amend IFRS 9, 39, 7, IFRS 4, and IFRS 16. What are the main impacts of these reforms? Well, there's a practical expedience for changes to contractual cash flows. There's relief from specific hedge accounting requirements. And as always, there will be disclosure requirements to tell. Now, these requirements are effective from 1st January 2021, but they're available for early adoption. Let's talk about these effectively. Now, I've got a lot of words in there, but what I want to try and tell you this is it's a simplistic way to explain or articulate this, right? When we say a practical expedient to changes in cash flows, what we're saying essentially is, look, when you're doing the change to LIBOR, and it's a LIBOR-related change, only LIBOR or IBOR or any other benchmark rate you're using, we are giving you a concession. but you got to make sure it's only related to that. It's no other aspect of the relationship. Now, in a hedge relationship, there could be credit risk, there could be exchange risk, anything of those sorts. We're not including those items. We're only looking at the risks related to the effective interest rate. Now, what they're saying here, essentially, all in all, look, your basis of cash flows is going to change, and this change is required by the reform if it's direct consequence of the reform, and the new basis is economically equivalent to the previous. So if you're doing something that is still a floating rate, it might be an overnight rate or whatever those kind of rates are, that is equivalent in pricing and nature to the IBOR, which is replaced, that is fine. Then you could apply this. And what it effectively allows you to do is that it allows you to revise the effective rate going forward. So the bottom line of this entire change is revised effective rate going forward. That's it. If you want to understand what this is allowing you to do, it's not saying use the original effective interest rate and continue to do the accounting, etc. It allows you a simple revision on an ongoing prospective basis going forward. If I didn't have this practical experience, I'd have a complex situation to do some kind of catch-up or relook at this or consider a modification, or is this a new instrument? This takes away all that discussion. Let's put this on a forward-looking basis. What do we mean when we say something is economically equivalent? So this is an example of this. You might have had an IBOR rate, which was a term rate, which was forward-looking and had a bank credit risk component in it. An equivalent rate could be an overnight rate based on historical transactions. See, this is very different to an IBOR rate. It's based on transactions. It's transaction focused. And I think the criticism in the LIBOR scandal was that LIBOR was not transaction-based. So this is based on transactions plus a spread. And this year, what we're saying is an apple-to-apple, economically equivalent change. It's something to price an interest rate. It's a mechanism, it's a pricing mechanism that is there to price your interest rate, and that is an economically equivalent change, which means you can continue to do the accounting on a prospective basis. In terms of hedge accounting, you may have had many hedges with this. What you need to do effectively, just change your documentation, change the way you're approaching the hedge. There are specific things allowed. And look, you can amend. I think the big thing, practical perspective, is you don't have to discontinue your hedge. You may continue your hedge, but just look, your hedge accounting will still apply. You still will have the normal calculations of effectiveness and ineffectiveness, and all other qualifying criteria continue to be met. All right. Finally, disclosure requirements. Again, with the disclosure requirements in phase 2, very comprehensive. Tell people what you're doing. Enable the investors to understand the risks from the reform and how you are managing that risk. I mean, this is a constant theme in IFRS 17. Whatever risk, whether it is market risk, credit risk, or liquidity risk, explain to the user the nature and extent of the risk. Similarly with IBOR reform, nature and extent of the risk, and also how you as an entity are you managing it, your progress in completing the transition and how the transition is managed, and how you achieve that objective. You provide quantitative information and a description to your risk management strategy. Under IFRS 9, because you don't have this, arbitrary risk hedging rules, you have a risk management strategy and a risk management objective. You would provide a description of how the risk management strategy is changed if there are new risks. All right. As I said, effective date for the phase 2, 1st January 2021. Amendments apply retrospectively. Restatement of comparative information is not required. Early application is permitted. And I think, look, it wouldn't be a bad idea to do an early application if you are impacted by it. If you are required to reinstate a discontinued hedge relationship only if somebody discontinued the relationship because of the reform, and you still continue to meet all the qualifying criteria for hedge accounting. I think that's all in all. It's an interesting reform. It's an economic event or an event which has got legal or something which affects accounting. Let me summarize that section before Brian takes you into the ISB update, and I think we may have questions. Just to summarize, LIBOR, IBOR, all those kind of benchmarks are going to be replaced by ABRs, which are alternative benchmark rates, and LIBOR will discontinue. And it was used in many, many transactions, like loans, receivables, payables, swaps, cross-currency swaps, and if you indexed your loan to some kind of LIBOR rate. If you have those items, then this section might be relevant to you. All in all, this makes your life easy. It doesn't force you to do modification or complex modification accounting. It doesn't force you to do to change what you're doing. It's practical experience by the ISB to make your life easier, and the common denominator, what I'm seeing, allows you to do hedge accounting as long as you continue to do hedge accounting and you continue to meet the other requirements. All right, so that's the IBOR reform in a nutshell. I don't know if we're going to take questions or we proceed to the ISB update. I'll hand over to take that.
Okay, Yusuf, thank you very much for that. I thought that was a fascinating overview of the impact of COVID on IFRS 15. IBOR reform here in London, very, very big topic. Really clear and good overview of that, Yusuf. So thank you very much for that. I think that's the end of your presenting, Yusuf, but I hope you're not going to go away. Before I start the ISB update, I'd just like to remind everyone that we are going to close with a final Q&A session. I will be there for that. Yusuf will be there for that. Gopal will be there for that. We still have the chat open. If you have questions on anything we've talked about in any of the sessions today, get typing, put your questions in the Q&A, and we will try and cover them in our closing Q&A session in less than 30 minutes. But right now, I'm back with you, and I'm going to take you through the ISB update. And if Rian or Diala are there, perhaps they could, behind the scenes, give me control of the slides so that I can take us through this ISB update. By way of introduction, I'm going to cover two topics. I'm going to talk about what the ISB itself has been up to. I'm also going to talk about what the IFRS Interpretations Committee, the IFRIC, has been up to. And possibly we're going to find it's the IFRIC that is going to have the most immediate impact on a lot of you. So I'm really pleased to present this session. For the last 18 months or so, I have myself had a role at the ISB. As Gopal said, I'm a member of the IFRIC myself. So at least some of the stuff I'm going to talk about is in fact my fault. So apologies for that. It does mean that I have a lot of access to the ISB. So if you have views on what the ISB is doing, if you want to tell me those through the polling questions, through the Q&A, then I will do my best to bring them into my discussions with the ISB. And in fact, let's start like that. Let's start by hearing from you exactly what it is you want the ISB to focus on going forward. So we have a polling question, and I'm going to restrict you to a single answer. So Diala, thank you very much for broadcasting the polling question. Suppose you were in charge at the ISB, you were at the ISB telling them what to do. What is the one thing you think they should do over the next few years? Should they focus on more COVID-19 related standard setting? Should they sort out intangible asset accounting? Should they look at non-financial reporting? Or, be honest, have you had enough? Do you think they should just leave you alone, do nothing for the next few years, and let you get on with your day job? If you could tell the ISB to focus on one thing, what would you want them to focus on? So I can see the time limit is up. So Diala, can you show me the results of the poll? This is really interesting. This is really interesting. I was expecting that everybody would come back and say, do nothing, leave us alone. But that wasn't a popular answer. In fact, the most popular answer was that you would be looking for the ISB to provide additional reliefs related to COVID-19. That is such an interesting answer. Up to now, the ISB has looked at COVID-19. They have amended IFRS 16 for the rent concessions amendment we talked about earlier. They have deferred the effective date of some changes to IS1 on current non-current classification of debt. They've extended some project timelines, but they have not and do not have a current intention to make other specific changes to IFRSs in response to COVID-19. So that's a really interesting message that I'll be very happy to convey back to the ISB in a week or so when I'm next round there. But let me move on with my presentation. As I say, I'm going to talk about the ISB, then the IFRIC. So if I start with the ISB itself. Now, every time you've been to an IFRS update, I'm sure you've seen a slide like this. What is newly effective for this current financial reporting period? Now, some years, when you've seen this slide, it's been a pretty scary slide, hasn't it? It's had really big, chunky new IFRSs on it, like IFRS 15, IFRS 16. If you're an insurance company, maybe you're looking forward to IFRS 19. This year is a different year. It's not like that. The things that are newly effective this year are much smaller and more contained. And in fact, when we designed the agenda, we deliberately included on the agenda the things that we thought were most likely to affect you. So Yusuf has been talking about IBOR reform in the second half of this slide. I've been talking about rent concessions under IFRS 16. Interestingly, rent concessions amendment, technically, it's only actually effective in 2021, but everyone I know is early adopting it. It's available for early adoption, so subject to local endorsement. Everybody has been adopting it this year in 2020. The other things that are on the slide, perhaps they'll be important to some specific transactions, but they're quite limited, they're quite contained. There's nothing else on the scale of IFRS 9, IFRS 15, IFRS 16, which, given everything else that's going on with COVID, might be a bit of a relief. Yeah. So in the very short term, the ISB has actually been quite helpful. So it is simplifying, it's offering ways to help you cope with IBOR reform, and it's simplifying the accounting for rent concessions. And it's only really when you look forward a little bit that you see the ISB having these big projects, these big reopeners that could have a really big impact on your financial statements. So let me just very quickly talk about what some of these big things are further down the line. The first thing I'm going to note just briefly is the ISB has this very important project on primary financial statements. There was an ED, the comment period closed just at the end of September. Now, one of the odd things about IFRS at the moment, particularly when you look at the P&L accounts, at the income statement, is you've got quite a lot of choice as to what you make your P&L look like. You've got a lot of choice as to which line items to have in the P&L. You have a lot of choice about where to draw your subtotals. You probably have lots of different alternative performance measures, lots of different types of adjusted earnings or net asset values or EPS figures that you talk about in your communications with your shareholders. That could change because the ISB, in its project on primary financial statements, is proposing to introduce a lot more standardization, a lot more detailed requirements, particularly in relation to the income statement and those adjusted revenue or profit or earnings measures that lots of people use. So it's still a little way off. The comment period has just finished. They received lots of comment letters, over 200 comment letters on these proposals. So it's not a big deal this year. There's going to be a big deal pretty soon. And if you are relying on alternative performance measures, if you're really wedded to that special subtotal that you draw in the middle of the income statement, and particularly if you have lots of external shareholders, I think you do need to at least begin to understand what's going on with these proposals. You know, you're going to have to change your KPIs, the way you relate your KPIs to your audited financial statements, then that's not something you're going to want to do overnight in a year or two's time. You will want to have a broader strategy about how you're going to communicate your changing business, particularly in this turbulent period. You know, you don't want to have all these COVID-19 effects and then paint yourself into a corner around presentation of KPIs and your income statement. So the first big thing the ISB is doing, year or two off, primary financial statements. Don't sit back. Don't sit back. You will need time to implement this. Next big thing the ISB is doing, again, a little way off, goodwill and impairment. Now, Yusuf was talking about the impairment test in the first part of the session. There's one thing I know everybody believes about impairment. It's hard, isn't it? It's a complicated standard. It's a complicated test to do. It appears to require lots and lots and lots of disclosure. But we hear lots of criticism. We hear lots of users saying the impairment test isn't really sufficient, it's not adequate, goodwill gets carried forward in the balance sheet for too long. And a lot of those disclosures are just boilerplate. And as users of the financial statements, we don't really understand what's going on. We don't really see the impairment test always as being a good way of holding management to account for the performance of their big acquisition. So the ISB is consulting on how to do the impairment test, particularly for goodwill. What should be the disclosures that go with that? And it's a discussion paper that's out for comment right now. Buried within the discussion paper is one of the all-time biggest technical accounting questions, and that is, do we stick with this capitalize and impair approach to goodwill, or do we go back to what a lot of people used to do under their local GAAP before they adopted IFRS? Do we capitalize goodwill and then amortize it on a straight line basis over 5 years or 10 years or 20 years or whatever it is? Now I think this is a live question right now, and for the first time in quite a long time, I think we and you could actually influence what happens here. As I said on the slide, the ISB has looked at this and they're quite finely balanced. So when they voted on this discussion paper, they said by a really small majority that they were going to stick with goodwill and impairment. Yeah, but it's a small majority, and if there's a lot of feedback in favour of amortisation, if there are new arguments in favour of amortisation, then I think the ISB could be persuaded to change its mind. So we're really interested to hear from you where you are on this question. So this is our next polling question. This is something the ISB is genuinely interested in hearing from you on. Should the ISB reintroduce amortization of goodwill? Now, the first view is that they should, and maybe you think they should do that. Maybe you think impairment is too difficult, it's too hard. Maybe you think that goodwill just hangs around in the balance sheet for too long, and you want the simplicity of amortization. If the alternative would be to say, no, we don't want amortization of goodwill, you might think, well, we don't want to change. Or you might think that you don't want to have a relatively arbitrary number in the P&L account. Remember, when people are disclosing adjusted earnings, almost everyone adjusts for depreciation and amortization. And Diala, I can see the results of the poll. I said earlier that the ISB was quite finely balanced. I can see in this group, and thank you so much for completing this poll, I can see in this group almost 2/3 of you would support seeing amortization of goodwill again. I think that means that a huge majority of you want the simplicity of goodwill amortization, taking the goodwill out of the balance sheet on some kind of systematic basis. So that's really interesting feedback. And again, I will convey that when I'm next at the ISB. So if I move on, there's something else. The ISB is looking at doing, and this is entering a new space. So up to now, the ISB is very focused. Its mandate is purely to look at financial reporting. What happened last month, I think, was a really systematic, really significant development. The foundation, the body that's in charge of the ISB, published this consultation paper. And they're looking for views as to whether or not the IFRS Foundation, instead of just focusing going forward on financial reporting, should they set up another body, another standards board that focuses instead on sustainability reporting? I think this is a very significant development. And in our poll as to what you thought the ISB should do going forward, the number one answer was they should provide more COVID-19 relief. The number two answer was that they should look at non-financial reporting. So I suspect I'm hearing from this group at least some support for the IFRS Foundation moving into non-financial reporting, moving into sustainability reporting. This consultation document, it's open just for a short period. Comment letters are due in by the end of the year. If you have a view on this, write in. It's a big legacy type change coming potentially from the IFRS Foundation. So those are the big things the ISB is up to, and I've summarised some of the other things that are going on and some of the comment deadlines on there for you to look at. As I say, there isn't a project quite on the scale of revenue or leases or financial instruments. There are lots of things that could have a big impact on individual businesses. So it's worth keeping up to date to track the individual projects you are most interested in. That said, I was going to talk about the ISB. Then I was going to move on to the IFRIC. So I'm on home territory here. I'm an IFRIC member myself, so I sit around the table or virtually I participate in the IFRIC meetings and we vote on agenda decisions. In the time I've been on the IFRIC, the main thing we've done isn't issue IFRICs like IFRIC 22 and IFRIC 23. The main thing we've done is issue agenda decisions. Now, an agenda decision typically sets out a fact pattern, and then it gives the committee's view, the committee's analysis of how the preparer should account for that fact pattern. Now, you might have a fact pattern quite similar to one that the IFRIC has been discussing. What if I and my colleagues around the committee table come up with an accounting treatment that is different to your current accounting treatment in your financial statements? What should you do? And this is our next poll. So Diala, please bring up the next polling question. And the question here is, if you see an IFRIC agenda decision that says the accounting policy should be X, you have a similar transaction and your accounting policy is Y, what should you do? So the first answer is you should change your accounting policy and say, look, we're very sorry, we got it wrong in the past, this is correction of an error. Second possibility is you should change your accounting policy and describe that as a voluntary change in accounting policy, so it's not an error. Still a change, but it's not an error. The third possibility is you do nothing, because IFRIC agenda decisions don't matter, and these idiots in London don't understand what's happening in your company. So time's up, and Diola, very interesting set of answers to this poll. So I'm really glad that very few people were on do nothing, because I think we'd all agree, actually, and for a long time, it's been the view of KPMG, and it's been the view of the other large audit firms as well, that agenda decisions matter. Agenda decisions matter, and people should be aligning their accounting with what they see in agenda decisions. I can see a real split between people who think they should be making the change and disclosing an error versus people who think they should be making the change and just describing it as a voluntary change in accounting policy. Now, I'm going to comment on this, but let me give you the authority for the answer I'm going to give you. So when I joined the IFRIC, this was quite a hot topic, actually. It was quite a hot topic. What really was the status of an IFRIC agenda decision? Did people have to make amendments and disclose them as errors? And if they were going to make a change, irrespective of whether it's an error, how long after the publication of the IFRIC update did they have? And all of these were open questions. This summer, the IFRS Foundation, the trustees, provided answers to many of these questions, and they did that by updating the IFRS Foundation's Due Process Handbook. Said a few things. So if I move quickly from left to right across the screen. So firstly, very importantly, it is now down there in black and white, the authority of IFRIC agenda decisions, all of that explanation in an IFRIC agenda decision, all of those additional insights, they're derived from IFRS standards. So if you're claiming compliance with IFRS standards, you should be following the logic of relevant IFRIC agenda decisions. Second box, when I joined the IFRIC, we'd have a meeting. We'd draft an agenda decision, we'd issue it for comment, we'd consider the comments, and then we'd go ahead and publish it. So we had quite a lot of power, actually. We had a lot of power. We could just go ahead and publish. That has changed. So the authority of the agenda decision has been confirmed, reinforced, but there is now an extra bit of due process. If I sign off a final IFRIC agenda decision, it then goes forward to the ISB, and the ISB itself is going to vote on each agenda decision before it becomes final. So I think that's a good thing. A bit of extra rigor and due process. The third box, which is precisely the question that we have the poll on. Is it an error? Have you made an error? Well, the Due Process Handbook says not necessarily. Actually, not necessarily. The IFRIC agenda decision might provide additional insights on a complicated question. And if that's the case, then you do not have an error. Yeah. Now, you might have an error if you were doing something completely and utterly outrageous that you know and your auditors know and everybody knows you shouldn't have been doing. That's still an error. But if there was a legitimate debate within the profession, amongst the firms, with different companies, with regulators, and something goes to the IFRIC, and the IFRIC publishes additional insights, then aligning with that could well be a change in accounting policy, not an error. Last box on this slide. How long do you have to do this? So an IFRIC agenda decision, it doesn't have an effective date, does it? It doesn't have an effective date. It doesn't have a transition provision or anything like that, not like a change to an IFRS would have. So you should be looking to apply these things as soon as is practicable. But working out how long that period is could require a bit of judgment. A really simple agenda decision that just required you to move 100 from one line item to another line item might take no time at all. A really complicated agenda decision, for example, last year's agenda decision on lease term that required you potentially to reopen lots of the judgments and estimates you made in your IFRS 16 implementation projects, something like that could take months and months and months and months in order to be able to get right. So when you apply an IFRIC agenda decision, it's going to take a bit of judgment. If it's simple, you do it quickly. If it's complicated, you probably got a bit more time, but not that much time. So what's the IFRIC up to right now? So I'm going to show you just one more slide, and this is the current agenda of the IFRIC, including things I expect to discuss in the next IFRIC meeting, which will be in December. So the first item on there, very important, very, very interesting, supply chain financing, what we often call reverse factoring. Now, this is a complicated area of accounting. We see all sorts of different versions of reverse factoring. In practice, these arrangements raise issues about what are the nature of the liabilities you should have in your balance sheet. Are they trade payables? Are they financing? It raises questions about what your cash flow statement should look like if you enter into reverse factoring. Is that itself a financing arrangement, or do you continue to have operating cash flows? And there are all sorts of disclosure questions, particularly when you start to apply IFRS 7 to the balances coming out of the reverse factoring arrangement. So we discussed this in May, and in June there was a draft IFRIC agenda decision that talks in quite a lot of detail about what to do in the balance sheet and the P&L, in the cash flow statement, and in your disclosures. I expect that we will discuss this again on the 1st and 2nd of December, and it's probably the biggest potential final IFRIC agenda decision that could be kicking around when you are finalising your annual financial statements. Other questions here? They're very interesting. Lots of questions the IFRIC has been looking at in relation to sale and leaseback transactions. And possibly the last thing I'm going to highlight on this slide is the second half of the slide, cloud computing. Now, so many businesses, including KPMG, are pushing more and more things into the cloud. The IFRIC a year or two ago looked at how to account for aspects of cloud computing. In particular, if you're the purchaser of a cloud-based service, should be capitalizing part of that contract. What the IFRIC is going to look at, probably in December, is a very difficult question. Again, if you're the customer in a cloud arrangement, you're incurring lots of costs to set up the system, maybe to customize or configure the cloud vendor's product to suit your business. If you're incurring lots of upfront costs, should they be capitalized and spread over the life of the arrangement? Should they be expensed? Does it depend? If it depends, what does it depend on? Very, very little guidance about that at the moment, and quite a lot of diversity in practice between different people in how they account for cloud arrangements. So this slide is showing you the current IFRIC agenda. I think the two issues that are most likely to be of broadest relevance is that one on reverse factoring. Could be a final agenda decision just in time for your annual financial statements. And then this big question about the costs of cloud computing arrangements, earlier stage in the discussion, but that could move forward quite quickly and be a really important issue in 2021. So I said I was going to talk about the ISB, which I've done. ISB, big things on the horizon, not that much newly effective this year. The things to focus on are the things we've been talking about today: IBOR reform, rent concessions. Looking forward, the ISB has some big stuff on its agenda. Primary financial statements, I recommend you follow that. Goodwill and impairment, sustainability. If you've got a view on these great eternal questions, then send in a comment letter. They're both due. They both have comment deadlines at the end of December. IFRIC, I think the IFRIC these days is where a lot of the short-term action is going to happen. You need to be on top of what the IFRIC is discussing now that we have all of that clarity about the status of IFRIC agenda decisions. And as I say, the two current agenda items I would really flag up for your attention are reverse factoring. Now, it could be a final agenda decision very soon, and then this very practical question about accounting for the costs in a cloud computing arrangement. Lots of diversity. I imagine there will be appetite at the IFRIC to limit that diversity if we possibly can. So that's the end of today's presentations. You've heard from Yusuf, you've heard from myself. We are all still here to answer your questions, and thank you very much, Rian, for putting that slide up with the first set of questions. And the first one is about long-term discount rates and the extent to which they need to factor COVID-19 impacts. Now, I'm going to say a few things about this, and then Yusuf, I'd find it really helpful if you could comment as well, because I saw this question in the chat, and I think it's a really interesting one. It's a really interesting one. And one version of it is, what do you do today if everything today seems completely and utterly uncertain? What do you do today if this year is awful, but maybe you think COVID is going to have a V-shaped economic impact, and by late 2021, 2022, things are going to be back to normal. And in the marketplace, I hear two schools of thought, really. I hear a bunch of people who want to say, well, this is a bad year, but the business is fundamentally sound. I don't want to be bucking too many losses this year. I don't want to have these huge impairments because I know things are going to come back. And I want to preserve that trend. The other thing I hear people saying is the exact opposite. They say, this is a bad year. This is the year I'm going to clean out my balance sheet. I'm going to put all the rubbish through the P&L. I'm going to take the biggest hit I possibly can, and then if things do come back, then I'll get the benefit of that in the future. Honestly, I think you have to work through the standard on a case-by-case basis. For me, the dominant feature of the market at the moment is just a lot of uncertainty about what's going to happen in the future. Neither of the two extremes I've described are necessarily the right thing to do. In a lot of cases, what I'm expecting to see is people doing scenario analysis, considering the different possible futures for their business, assigning probabilities to them and using that to inform the work they are doing. And that's a very general comment. And I guess, Yusuf, there's a specific question about what to do with long-term discount rates when you have short-term disruption.
Yeah. No, I think, Brian, you've covered it adequately there. The principle we cling to in an IAS 36 environment is whatever adjustments can be made to the cash flows are not made in the discount rate. The whole philosophy is not to double count. We don't want to double count the risk. So I think the way we balance this is, if you're looking at long-term projections, you apply a degree of conservatism in the cash flows, then you have a different situation in the discount rate. But I think the way we got to do this is a scenario kind of basis. We look at scenarios, we look at the likelihood of those scenarios, I think would be the best way. I think what would happen is before we'd have probably one or two scenarios, we'd have a best case and a not so good case scenario. But I think now going forward, we have to look at scenarios and the likelihoods of that scenario could be factored in. Now, in terms of long-term discount rates, I think, look, the calculation for an impairment must be based on information that exists at the point in time. That exists. I think trying to over-predict or something is not what's required in IAS 36. The discount rate projection is not the same like a macroeconomic forecast that's required by IFRS 9. I think take into account scenarios that could happen and exist at the reporting date or at the measurement date and do some calculations on that. But as I said, I think if you're adjusting the discount rate, look at your, the cash flows would be, you either balance the two in terms of the cash flows or the discount rate, but never double count for the same risk in both of those. So the long-term discount rate, I think if you're uncertain, yes, absolutely, it will be captured if your cash flows are not certain. But, it's all linked to probabilities and numbers, and I think there's a lot of mathematics in there more than an accounting. We can move on to the next question. Do we recognize discount upfront or amortize it over the accounting period? I'm thinking that this is a discount allowed.
I feel it's a rent discount.
It's a rent discount. Okay, so this is a lease incentive. Okay, so This is a lease incentive question. Brian, you can pick this one up. And then I think the third question is linked to if the event is cancelled. So this is, you're probably an events company, you're cancelling an event, you've got funds collected in advance that is not going to be refunded. So, okay, so if I've identified your performance obligations and look, you've got nothing to do, you've got no other element to do or anything or something, and you've got unconditional entitlement, can it be considered as revenue? And if you're referring to revenue as income in ordinary activities, that would be your assessment. If you're asking if it is income or revenue in a broader scale as IFRS 15, so there has been a contract with the customer, and yes, if you're getting money on, I look at it like normal breakage, which comes in as income. I think that would be that. I think on point 4, I think it's addressed to Brian. So I think questions 2 and 4, Brian, you can pick up. I've just
Thank you, Yusuf. I'm very happy to do that. So I think it was clarified that question 2 is really about a kind of discount that is offered in relation to the lease, perhaps as part of a rent concession. Just to confirm some of the things I was talking about earlier, I think the accounting, let's assume it's an operating lease for the lessor. The accounting is going to be very different for the lessor and the lessee. So on the lessor side, if you're doing operating lease accounting, and you agree with the lessee that you're going to reduce the rents perhaps for the next 3 months or perhaps for the next 12 months, something like that, the accounting there is that you will calculate the revised lease payments over the revised lease term. You will straight line them, and the effect of that is that you will have straight line income recognition going forward, and in effect this discount is being spread over the remainder of the lease term. If you're the lessee, so if you're the tenant in a real estate lease, it will almost certainly be different. If you're applying the practical expedient and your landlord, your lessor, has agreed to waive some of your lease payments or even just defer them, you will recalculate the lease liability. If you're using the same discount rate, because you have lower cash flows and the same discount rate, your lease liability will get smaller, and the other side of that entry will go to P&L, and that will happen in the periods affected. If the rent concession is wholly unconditional, then the whole benefit of that gain will go to P&L when everything is signed. So it won't be amortized, it will all go to P&L in the period if it is unconditional. If it's conditional, perhaps the agreement says you only have to pay 50% of your rent for the next 6 months if in each of those 6 months, the COVID alert level is amber or red, then that is a monthly condition. It would get tested each month, and you would have a credit to the P&L for that month's rent forgiveness in each month that you qualify for the concession. So I'm slightly summarizing, but lessors in operating leases are typically going to spread this stuff forward over the lease term. Lessees applying the practical expedient are typically going to take these things to P&L in the very short term. Question 4 on the slide is about the IAS 16 amendment on proceeds. So you've got an asset, perhaps you're testing it, perhaps you're producing byproducts, but the asset isn't fully ready for its intended use, and perhaps those byproducts are resulting in some incidental income. So specific amendment to IAS 16 specifying exactly how you should account for those proceeds. Should they reduce the carrying amount of the PP&E, or should they be in the P&L as income? I'm afraid I don't have the right material with me to quote with confidence the effective date and that kind of thing. We do have a web article, we do have resources on this, and we'll be sure to email the link round when we finish this session. So I think those are the questions that were on the slide. Thank you very much for that. I can see we're coming up to the finish time for the event as a whole. So Gopal or Rian, perhaps I will hand back to you for any closing comments.
And participants, I would like to thank Yusuf, Hasan and Brian for an insightful IFRS update session today. I would also like to thank KPMG Markets team for arranging this excellent event. If there are any further principle-based questions from the participants, please do reach out to us and we will ensure to get back to you with the appropriate answer. We will also be emailing to the participants a copy of presentation shortly on their email IDs. At the end, we are very keen to receive your valuable feedback on today's session. There is a quick survey at the end of this webinar. Please do share your valuable inputs. Thanking you and signing off, and a good day ahead. Thank you very much.